This is Bloomberg Surveillance with Tom Keene and Paul Sweeney.
Are these stocks under-owned by institutional Wall Street?
A lot of these companies talking about generative AI.
With Lisa Mateo on markets.
Investors just worried about the ongoing sales slump in China.
And Michael Barr with news.
A ship traveling through the southern Red Sea has been attacked.
The best in economics, finance, investment, and international relations. This is Bloomberg Surveillance on Bloomberg Radio.
And a very good morning, everyone. Bloomberg Surveillance on this Wednesday, October 16, 2024, live from our Bloomberg Interactive Brokers studio. We are on Bloomberg Radio and, of course, on YouTube. Yeah, this isn't Tom Keene's voice. Tom is off. Paul Sweeney is on assignment. You're going to hear from him a little bit later on Bloomberg Intelligence. I'm Carol Massar along with Barry Ritholtz. You're taking a picture. We got a show to do. I love it. He's always on social. Well, a very good morning. Barry, of course, host of Masters in Business broadcast, also his podcast At the Money series. Good morning, good morning.
Good morning. How are you?
I'm doing well. I feel like we got a fair amount of stuff going on.
So much news. The news flow is just a fire hose today.
Well, and it's interesting, like the global chip space, you're looking at, more than $400 billion being erased. You've got luxury stocks under pressure over in Europe, and then we've got another big bank reporting earnings in about 29 minutes.
Right. Morgan Stanley, that's going to be really interesting. I think that rounds out all of our bank earnings. You know, every time I hear people complain about, oh, look at this drop in chips, you have to put it into context of what a giant rally the semiconductors have enjoyed for the past, 2 years. It's been massive. Giving up $400 billion feels like, all right, that's a couple of weeks of gains, but that's it.
Yeah, listen, in 2023 alone, that space was up about 65%, right?
Unbelievable.
And our Ian King will remind us it's cyclical. Stuff happens. So we're going to dig into that. We're going to dig into that Donald Trump conversation, former president, Republican candidate for the White House, talking with John Micklethwait. They talked a lot about tariffs, but there's more to it.
Yeah, there's a whole lot more to it. You know, this is such an unusual election cycle. Not just the switch from Biden to Harris, but the way Trump is so disruptive in the 2016 and 2020 election, we're expecting more of that. The disruption is coming in a very different way. I couldn't imagine him sitting for this sort of election, this sort of interview in the 2016 election.
I will say what's happening with, 3 weeks to go, under 3 weeks to go, is that you are seeing both candidates in all these interesting media spaces, right? Trying to get their face out, get their message out, and I think reach different parts of the voting public.
No doubt. Trump on Bloomberg, Harris on Fox News. It's like it's backwards world.
It's bizarro world.
Bizarro world.
All right, we're going to dig into that. We've got some great guests coming up. They're going to roll it all together in terms of the elections, the sector pressures, what visibility we kind of have from this point on. But right now, we want to get a check on that Wednesday setup. Let's turn things over to Lisa Mateo. She's got a Bloomberg Business News Flash. Good morning, Lisa.
Yeah, you got it. Good morning. Futures right now pretty much flat. Big bank earnings wrap up this morning. We have Morgan Stanley out in about a half hour from now. So let's get to the futures. So we have NASDAQ futures up about 0.1%, 23 points. Dow futures, little change, down about 7 points. S&P futures, little change, up about 2 points. The 2-year yield, 3.92%. That's down 2 basis points. A yield on the 10-year, 4.01%, and that's down 2 basis points. To commodities, we have Brent crude, $73 a barrel. WTI crude, $70 a barrel. Some more Fed speak. The Fed's Raphael Bostic said he expects U.S. growth to slow in 2024, but remain robust. He sees the benchmark rate dropping to about 3% to 3.5% in the long run. And we're keeping a close eye on chip stocks this morning after a combined $420 billion in market value was erased. A big part of that, a slower outlook from chip-making equipment supplier ASML Holdings. Shares tumbled by the most since 1998 in Europe. Right now, ASML Holding down 3%. Checking in with NVIDIA, it was lower. Now it's up by about 0.5%. And finally, shares of fashion retailer LVMH under pressure, down 4% in Paris. Sales fell for the first time since the pandemic. The slump in demand from Chinese consumers seems to be worsening. That's your Bloomberg Business Flash. Carol and Barry.
Paris? Is Tom in Paris? Is he shopping there?
He's at a wedding.
Oh, he's at a wedding.
He's probably shopping, yes.
Just saying. Got to help him out. All right, Lisa Mateo, thank you so much. Carol Massar along with Barry Ritholtz. We are in for Tom and Paul here on Bloomberg Surveillance on this Wednesday edition. We want to get into it and talk about some of the big trends that are out there. We've got a great guest to do that. Aoifinn Devitt, she is Chief Global Strategist over at Moneta. It is a 100% partner-owned registered investment advisor, and she joins us on this Wednesday. Aoifinn, good to have you here with Barry and myself. There's a lot to kind of tackle that is coming at investors right now. Some would say between the elections, geopolitics, concerns maybe about earnings, it's early on the season, that maybe we just kind of park a bunch of stuff in cash at this point and kind of ride it out. What do you say?
Probably not what we're going to advise, though. Whereas having stuff in cash worked well when interest rates were high, unfortunately, our clients aren't really in a position to tactically move things around. So what we're really trying to get them to do is stay the course, not be too reactive, and wait and see, and have a bit of a strong stomach at this point, because we do think that the next 20 plus days are going to be a bit of a wild ride. We can see some expectations exceeded, some dashed, and a political backdrop, as you just noted, that is really unprecedented.
So I'm glad you mentioned not trying to be tactical, but at the same time, lots of investors have been thrilled getting 5% in money market funds, at least for the past year or so. What are you guys doing with just spare cash that's looking for yield now that we're starting to see money market yield kind of slide below 5?
That's a great question. I mean, it's sliding slowly below 5, so we're still in a much better place than we were when cash used to be a drag on portfolios. But we are starting to look at the margin back into the fixed income complex, see where opportunities are interesting there. Spreads are pretty tight, but still, you're still getting a yield that's higher than you would have got a few years ago. We've always had a pretty core exposure to equities, and that wasn't particularly thematic, so it wasn't riding with the volatility of tech stocks. So that's looking quite good. And we've always been open, at least to some of the alternatives, and some of the areas like private credit that have really stayed the course, have been a very steady source of income. And we haven't been as open to some more speculative asset classes, but we've always been in education mode around that.
Really interesting. In your most recent note, you mentioned oil is down about 4%. And that kind of implies the market is not really worried about geopolitics. Kind of shocking considered how much stuff is going on, not just Russia and Ukraine, but the Middle East, and not just Gaza, but now spreading out to other parts of that conflict and the threat of a broader war. How are you looking at what's taking place geopolitically?
It remains a modern wonder of our age that markets are continuing to be so resilient despite the political maelstrom on the domestic front, and despite what Ian Bremmer describes as a geopolitical recession. We never had our actual economic recession, but we have had geopolitical recession in terms of just this coincidence of massive numbers of shocks and surprises on the geopolitical front. These do have the potential to disrupt supply chains and disrupt the price of these raw goods, but it's not happening. And we can see that perhaps there has been a lot more nearshoring. The pandemic certainly really tested these supply chains and networks, and you can see that they've come out the other side more resilient, that they've perhaps been stronger where the cracks were. And now we can see that markets are sort of sailing through breezily without paying much attention to it. So it remains a wonder. I don't quite understand it, because I think there is some more concern. But, you know, it's a nice problem to have, in that the portfolio remains resilient. Portfolios of our clients remain resilient.
Well, I do wonder, even in terms of the commodity market, specifically when you talk about oil, energy, that there's a lot of supply out there. And I feel like the metrics have changed dramatically. So I do wonder about that as an indicator. Having said that, I also do wonder about the last 20 years or so, certainly the last decade, of just money being so cheap and things distorted. And are we yet through that cycle here today?
I would say no, we're not through the cycle of cheap money and searching for yield. We can see that immediately. There's a dip in the market. There's a flood of money out of money market funds into equity funds. So there's still a sense that you are not going to make money investing in cash or investing in bonds, especially if you have FOMO when you look at those double-digit record number in equity markets. So there is still that sense that I would need to get risk on, and a very strong drive to do that. I'd say overall, we can see that when it comes to the geopolitics and the focus on energy, yes, we are in a place now where energy security is clearly of prime importance, but we've done much better job around supply. The exception to that is Europe. We're coming into the winter now. There's going to be a question mark around what Europe potentially will have when it comes to their energy supply. Inflation's very low here. It won't upset the apple cart. but that is a bit of a question mark around energy here.
You mentioned an inflation low. UK inflation coming in at 1.7%.
They're feeling pretty happy this morning,
right?
A little bit.
And you know, I'm still perplexed by people who are fighting the last war and are arguing about sticky inflation. It's clearly not happening in Europe or in Asia. At 2.5%, can we declare the inflation battle won now here in the U.S.?
We can. The people who are not celebrating, of course, is anybody who has their assets in sterling, which has taken another dive against the dollar today based on the expectation that the next rate cut is a whopper one, a 50 basis point jumbo cut here in London, the Bank of England. So clearly there's a rough and the smooth with those inflation numbers. But yes, your point, I think we have now moved on. I've seen the language used around a hinge economy. Has the economy now kind of turned a page? Inflation is not a concern. We're back to worrying about growth, where we get it from, employment. We're not worried about overheating. And in the nice position that the central banks have a significant amount of arsenal with which to stimulate the economy when they need to. So is it over? Well, certainly we don't know whether all supply chain problems are fixed. But certainly it's not over as an election issue, though, as you well know, because this is still front and center of the voters' minds.
Yeah, and I would say that stronger inflation reading for September in the U.S. made everybody kind of reset in terms of their expectations for the Fed. Aoifinn, we got to run. Aoifinn Devitt, Chief Global Market Strategist over at Moneta, joining us on this Wednesday. Right now, let's get an update on world and national news. For that, we turn things over to Michael Barr. Hi, Michael.
Hi, Carol, Barry, and Lisa. Republican presidential candidate Donald Trump defended his plans to overhaul the U.S. economy through dramatic tariff increases and more direct consultation with the Federal Reserve, arguing that his policies would result in substantial growth, despite projections that his agenda would fuel inflation. Trump spoke with Bloomberg News editor-in-chief John Micklethwait in an interview at the Economic Club of Chicago.
To me, the most beautiful word in the dictionary is tariff, and it's my favorite word. It needs a public relations firm to help it, but to me, it's the most beautiful word.
Meanwhile, Vice President Harris wants to legalize recreational pot on a national level. While on the Breakfast Club with Charlemagne the God, Harris says she was against harsh penalties for weed crimes when she was the San Francisco district attorney.
To make it classified as a lesser harm. And so that took some time. There's a whole process around that, but that's the work that we have done.
Only 20 days are left until Election Day. Secretary of State Antony Blinken and Defense Secretary Lloyd Austin are warning the U.S. may withhold military aid to Israel if it does not improve the humanitarian situation in Gaza in the next 30 days. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Carol, Barry, Lisa.
All right, guys, thank you so much. Carol Massar along with Barry Ritholtz in for Tom and Paul here on Bloomberg Surveillance. You were kind of like, Massar, did you get inflation right? It was a little hotter for the month of September, the CPI print.
See, I thought people freaked out over the non-farm payrolls number.
Well, that too.
But, you know.
But that's a good sign, too, potentially.
You know, people misunderstand that. 259 is, it's such a noisy data series subject to updates and revisions. You really have to take it with a big grain of salt.
The only thing I would say, we are certainly in an environment where it's like data point to data point. Right. We know that from the Fed, but you see the market reaction. If anything's a little hot in terms of inflation or even stronger than expected jobs, investors react.
Right. Meanwhile, I'm shocked to learn that weed wasn't legal nationally. I walked down the street in the city.
Something you want to share with us?
It just feels like, aren't we years past that already? I'm shocked about it.
I got to tell you, I get a contact high. Is it a street high? Like every time I walk down. All right, Carol Massar, Barry Ritholtz, you are listening and watching Bloomberg Surveillance.
Flash.
And this Bloomberg Business Flash brought to you by IBKR. With Interactive Brokers Forecast Trader, you can trade your views on key economic and climate indicators. Visit ibkr.com/forecast and get started today. All right, let's get started with futures. And there's not much movement. This is all as we await Morgan Stanley earnings about 15 minutes from now. Stay tuned for that. Nasdaq futures up about 0.1%, 31 points. Dow futures little change, down about a point. S&P futures little change, up about 4 points. The 2-year yield 3.92%. That's down 2 basis points. The yield on the 10-year 4.01%, and that's down 2 basis points. To currencies, we have the dollar stronger, Japanese yen weaker at 149.40 against the dollar. Euro, British pound weaker. We have Bitcoin up 2% at around 67,000. More economic data out this morning. The MBA says mortgage rates, they rose for the third week in a row, pushed applications for mortgages down 17% last week.
That's not good.
No, the average 30-year fixed rate now at 6.52%. All right, we have more data to come. 8:30, stay tuned. We'll get a read on import prices. Companies making news, that's Qualcomm. Sources say it'll probably wait until after the U.S. election before deciding on a takeover of Intel. And then Ram's parent company, Stellantis, reportedly taking steps to build its best-selling truck in Mexico. That's according to the Wall Street Journal. And that could really threaten the company's relationship with its workers' union. And finally, sources say Airbus plans to cut about 2,500 jobs at its space and defense unit. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash. Carolyn back.
Great stuff, Lisa. As always, Lisa Mateo there. You're like, right?
Yeah.
It just shows that companies now are starting to maybe like, let's hold off and see how this race here in the U.S. pans out.
You know, when you step back and look at the long term, it's just a reminder that it doesn't matter how great the company is. Apple, Nvidia, Google, Amazon, eventually the cycle turns and the new thing shows up. Intel was such a dominant company for so long.
I know.
And now Qualcomm is going to buy them like, yeah, we'll see if we can squeeze them in somewhere, as if it's a minor acquisition.
It's pretty wild. All right, we're going to talk hopefully semis a little bit later on. In the meantime, we want to talk about some news we got out of the UK this morning. UK inflation slipping below the Bank of England's 2% target for the first time in more than 3 years, and that brought about investors to bet on quick cuts in the coming months. So let's talk about that. Janet Mui is head of market analysis at the British wealth management firm RBC Brewin Dolphin, joining us here on Surveillance. Janet, good to have you here on Surveillance. Let's talk about that UK inflation number, how important that is, and if it impacts your thoughts kind of on strategy and outlook here.
Thanks for having me.
Yeah.
I think it's good news. It dropped below 2%. And in fact, I think it came below the Bank of England's own forecast. And I think it pretty much cements the rate cut in November, because I think it's highly likely anyway, given that they do that quarterly forecast in November. And it is a great opportunity to lay out the outlook and the opportunity to cut as well. And also, if I look at the inflation data, it is pretty broad-based as well. It is mainly driven by airfares, but I think generally broad-based slowdown. So in terms of how it impacts our thinking, well, we have been overweight on UK gilts, and we have added a bit more early in the month when the yields have picked up, because we believe that UK inflation generally heading in the right direction, or at least stabilized, whereas UK growth outlook, is okay, but then I think markets have underappreciated the room for the Bank of England to cut, which I think could be more aligned with the cadence of the Fed cut. So yeah, so we're in terms of implication, we just reinforces our overweight gilt position.
You know, I noticed that you recently increased the overweight in government bonds. That suggests you're expecting much deeper rate cuts and the bond market to rally even further. Give us some sense of how far the Bank of England can go. And obviously, this is based on inflation being thoroughly defeated and in the rearview mirror.
Yeah, I think inflation is hugely important, and I think we're seeing great progress. So I think the expectation is that we're going to see rate cuts in November and December, and I think a couple more in 2025 could potentially go to toward 3 to 3.5%. I'm not sure, really data dependent. But what we observe is that, I think currently there's a lot of uncertainty with regards to the UK budget, and we know that there are going to be tax increases. So net, I think near-term economic impact could be negative in terms of sentiment, business spending. So I think that could be potentially the driver of the room for the Bank of England to cut more if inflation stays low.
Hey, Janet, one thing I wanted to ask you, I hear a lot of guests come on Bloomberg and they talk about Japan in a big way in terms of investment opportunities. Having said that, the U.S. continues to be one of your favorite markets. How come, considering what we've seen, already about a 22% gain on the S&P 500?
Yes. So I think primarily it's based on the fact that UK companies, US S&P 500, they have the best companies in the world exposed to structural growth stories. So that thing is not changed despite the market volatility. I think investors in general, whenever there is a bit of negative news out there, they tend to sell tech, which impact the U.S. But at the same time, when things get all right, when we get reassurance that it is a soft landing, the Fed is cutting, corporate earnings are all right, they lean back to the tech sector. We have seen that play out over and over again. I think ultimately that really depends on the structural earnings outlook and the exposure to AI. Where the U.S. is just have the largest exposure, and you just don't want to underweight that. So I think that really underpins our overweight in the U.S.
So I also noticed you upgraded Asia ex Japan. We saw in the third quarter the performance of both international stocks and emerging market stocks. Why Asia ex Japan as opposed to the entire region?
Yes, Asia, Japan. So primarily it was really due to the China upgrade based on the comprehensive range of stimulus measures. I know that the Chinese market is highly volatile, but I think given the valuation, there's still attractiveness in the medium term. We think there'll be more stimulus to come because I think there's some fundamental change in the thinking of the Chinese officials, as in they know there's a need to stimulate consumer spending, potentially via handouts. And I think Asia ex Japan because, you also, excluding China, you also got countries that is very exposed to the AI semiconductor sector, which is Taiwan and South Korea, which still structural growth story, and of course India as well. So I think overall speaking, we're comfortable to increase it as a whole in terms of Asia ex Japan because of both China and also the other favorable areas exposed to the tech and semiconductors.
Hey, one thing I wanted to ask you, Janet, is, the CSI 300, ending the day a little bit lower today, its declines from an October 8th high are now about almost 10%. So we're on the verge of a correction for Chinese stocks. Is that part of the reason? And obviously what seems like nonstop stimulus that comes out of the government, although people keep waiting for, I think, even more. Is that your interest in China? Is it just that they're oversold or what? Or you see the fundamentals improving?
I think it's a combination of all of that. I think investors have become very frustrated. International investors have been still very doubtful. We have been skeptical for a long time, actually. But I think there are some difference this time. As I said, the government has changed some mentality, as in they're more willing to support household consumption directly by handout. And also, I think the thinking they are tackling the problem is actually correct, right? The housing sector, reducing excess inventory, injecting capital into banks, supporting local government, those are all in the right direction. So those are good signs. And I think the valuation provides some cushion to that view.
All right, going to leave it on that note. Hey, Janet, thank you so much. Have a great day. Janet Mui, she's head of market analysis over at RBC Brewin Dolphin. Barry, just got a few seconds before we head to break, but are you looking at overseas, Asia in any way?
We're overexposed, always exposed overseas because you can never tell.
China too?
If it's part of the emerging market index, we have a piece of it because you never know when you're going to get a quarter like third quarter. Emerging markets were one of the best performers. The best performer was the Russell 2000. The weakest was the NASDAQ 100.
Yeah, something to keep in mind here, right? In a big way. All right, everybody, we continue on Bloomberg Surveillance. Carol Massar along with Barry Ritholtz in for Tom and Paul. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo, and futures are flat as we get Morgan Stanley earnings coming in across the terminal. The headlines, their third quarter wealth management net revenue higher than expected. Morgan Stanley's third quarter equities trading revenue higher than expected as well. We will have the CEO, Ted Pick. He's going to be on Bloomberg at 10:30 Wall Street time. Be sure to tune in for that. Right now, we have Morgan Stanley. Shares just jumped. They're up about 3% right now. U.S. Bancorp's lending income, that topped estimates in the third quarter. Their shares up about 1.5%. And after the bell, we're going to hear from Discover. Futures, let's get to that, up about 0.2%, 39 points. We have Dow futures, little change. S&P futures up about 5 points. The two-year yield 3.92%, down 2 basis points. The yield on the 10-year 4.01%, and that's down 2 basis points. United Airlines, they reported third quarter results. Analysts mostly positive, but Barclays said the upcoming U.S. election likely to knock fourth quarter demand. Shares were lower. Now they're up about 1%. And European budget carrier Ryanair, it says the strike at Boeing compounded aircraft delivery delays affecting the outlook for passenger growth next year. ADR is down nearly 1%. That's a Bloomberg Business Flash. Carolyn Barry.
All right, Lisa, thank you so much. I'm going to stick with what Lisa highlighted for us, those Morgan Stanley earnings crossing the Bloomberg. Stock still up about 2.5%. So we're seeing a spike. Third quarter wealth management net revenue, $7.27 billion. Estimate was $6.88. Third quarter equities trading was $3.05 billion. That's a beat, $2.7 billion. Total client assets surpassing $7.5 trillion. I guess they're doing okay.
You know, you look at how the quarter ended. We finished at all-time highs across all the major indices. Not a big surprise that if you're running $7 trillion in client assets, you're going to do really well. If they get billed, that's the fabulous thing about the asset management business. It's got a built-in 7, 8, 9% annual growth, right, just based on what the market does. And when you have a year like this where we're up double digits, you know, at the end of the third quarter, if you're not putting up great numbers in your wealth management division, you're doing something wrong.
Yeah, that's a really good point. And the other thing is, you know, we've been worried about net interest income for so many of these big banks. And you're looking at third quarter net interest income at Morgan Stanley, $2.2 billion. That's above the estimate of $1.87 billion. So it looks like you look at pretty much every provision, and they seem to be doing just fine. Third quarter provision for credit losses, $79 billion. The estimate was for $60.7 million, Barry. So, you know, we've heard from all the big banks yesterday, throughout the week. We heard from them, of course, JP Morgan kicking it off on Friday, and it seems like the sector doing okay, more than okay.
Right. You're giving up a little bit of interest income as rates have come down, but you could tolerate that when the S&P 500 is up 23% year to date, and we still have 10 weeks left to go in the year.
Right.
The slight uptick in delinquencies, slight uptick in credit. We'll talk to a guest about that later, but it's relatively modest compared to what we've seen in other eras where it feels like a recession is coming. There's really no signs of that now.
We don't see it. And I will say yesterday in some of the bank reaction, whether it was Goldman with Citi, Citi's got its own things as it's kind of reworking some things. There was some pressure on some of those names. They initially rallied and then pulled back a little bit. But yeah, third quarter total deposits from Morgan Stanley. Here's another number, everybody. $363.72 billion. That too is a big beat. $348.63 billion was the estimate among the street. So again, just really kind of killing it.
And let me point out.
Do you like the big banks?
So when you look at JP Morgan and Goldman Sachs and some of the other banks, they have very much recovered from their I can't believe I'm going to say this, great financial crisis crash. Citi.
It's been 16 years.
But
it's taken a while.
Is still the redheaded stepchild. They're 80% or so below where they were 2007. Stop and think about how long that's been dead money. So whenever people raise Citi as look, there are some delinquencies, there are some issues, maybe the banking sector is cracked, it's like, no, you got to pull that one problem child off to the side. Look at Morgan Stanley, look at JP Morgan, look at Goldman Sachs. It's hard to be very negative about that sector when they're just putting up great revenues and great profits.
And I will say, Citi was down about 5% yesterday. Their net interest income did fall short of expectations, and Jane Fraser had to kind of defend that they're not facing an asset cap. There were some concerns about that yesterday, so there were some interesting trades on that. All right, we're going to continue to track certainly the big banks. Morgan Stanley now up about 2.9% here in the pre-market, so we'll continue to go through their results. In the meantime, we got to go back a little bit to what we saw in, and we continue to see in the European trade, because we have seen some pressure. Weak luxury sector, thank you, LVMH. That added to some negative sentiment. And also, of course, we're watching ASML, which continues to get beaten down after a lot of pressure yesterday, reducing its outlook. So some concerns once again in the semi sector. Let's get to Pooja Kumar. She's head of European rates, and she's strategist there at the Toronto Dominion Bank, joining Barry and me. Pooja, let's walk through the European trade. Concerns about semis once again, but the UK getting some softness in their inflation print. Where should we be starting on this Wednesday?
I think, first of all, great news for UK, where markets have been extremely nervous about the budget. And today's inflation report, again, it was a volatile report, but we do think that the entire currently where UK inflation is sitting, it's below what BOE was expecting in August. So I think this aligns well with what we heard from Bailey 2 weeks back, that they're ready to go aggressive if they see all their conditions are being met. But I think as something that we have flagged very well is it's the budget. The budget is still the big concern for us. Will it be actually growth stimulating that actually limits how much BOE can cut? So yes, we are seeing a great rally, but I won't be surprised if that rally disappears as we head closer to the budget time.
So I'm kind of fascinated by the budget debate in UK in general and Europe more broadly. We were just talking about the financial crisis. In the 2010s, it seemed that the austerity folks had gotten their way, and it very much slowed down the economies in places like Greece and the UK. How are you looking at deficits going forward? Is this an overhang on the economy, or is it, like here in the United States, potentially stimulative to more economic growth?
So yeah, I think US is clearly different when it comes to, and it gets away with everything as well. But as you mentioned, we have been on this rigorous path of reducing deficits across the board. And that's why in terms of growth and productivity, our countries have suffered. Brexit, Ukraine, COVID shocks, everything has actually added a lot in terms of negative impact to growth. So when it comes to UK, our deficits are still 4% versus, US, where we are thinking closer to 7%. But just because it's an open economy, we depend a lot on non-domestic investors, and we have the trust fear. I think it's very important for UK to actually show a declining trajectory when it comes to deficits. But to your point, when it comes to Europe and UK, we need that fiscal to actually fix the structural issues that we have, which cannot be fixed by just monetary policy.
So since you mentioned monetary policy, it feels like the Bank of England has been ahead of the curve versus the Federal Reserve in cutting rates and setting targets. What do you think the terminal rate is going to be in the UK from the Bank of England when they're done cutting?
So TD is actually looking for a terminal rate of 3%. Surprisingly, markets don't want to place the terminal rate of UK below US, which I kind of disagree. If you think about US, the growth is we had 3% growth, but in UK, we are literally hanging around the 0.5% growth. So to me, if this budget sails through well, you could see a pretty strong performance in UK versus US, where markets are underpricing BOE's terminal rate, which should be much lower than current expectations.
All right. Pooja, thank you so much. Pooja Sirim, she's Senior European Rate Strategist, joining us from Toronto Dominion Bank on this Wednesday. Hey, folks, we want to kind of jump into Morgan Stanley earnings because we see the stock up about 2.8%. Sales trading revenue beating estimates. Our own Sonali Basak, she follows everything when it comes to high finance and those Wall Street banks. She, of course, is co-host of Open Interest, too, on Bloomberg TV, joining Barry and me in our Interactive Brokers studio. This looks like a blowout report.
You know, it's 7:30 a.m. and I'm wondering what the cocktail party looks like tonight at Morgan Stanley because they just blew it out of the water. And it's amazing because you have to understand it's only really the third quarter here that Ted Pick is existing as the CEO of Morgan Stanley. So he has a lot to show here. And what's interesting is they beat across almost every revenue line. Very, very strong quarter in the wealth management unit as well, which is the business he did not lead.
Right.
And then also sales and trading, both in fixed income and equities, above expectations. Investment banking, broadly above expectations. The only line they fell marginally short there was equities underwriting. Interesting, though, because they were able to beat in equities trading even without that extra equity underwriting revenue. So
what does that say?
So it means that, you know, one thing I'm going to ask about really is some of that coming from financing as well. Goldman has been leaning in on their trading desks by getting more clients by providing financing. At Goldman, the equities trading desk came in above Morgan Stanley. It is worth asking about the differentials. Morgan Stanley used to be the historic kingmaker in this room, but Goldman has been beating them in several quarters in recent years.
How much of this is just we've seen a general slowdown in IPO issuance and secondary issuance the past couple of years? Are there just the same group of people fighting over a smaller pie?
You know, that's a great question because it could almost be forgiven, right? Because we haven't seen that many IPOs. If Ted Pick, the CEO, comes out and says, we have a massive pipeline, that's a different story. Another question is, well, wait a minute, is there a recognition that companies are staying private longer?
Yes.
We're going to be doing more to try to serve those people instead. Citigroup kind of touting their relationship with Apollo yesterday. Front page of their earnings report, I thought was pretty fascinating. It tells you where we are. It's recognition that private markets are a big, big deal. Goldman also putting that front and center in their report.
Was it the folks at Apollo, too, who just talked about kind of the merging of the private markets and the public markets, which makes me like, okay, where does this all go then?
Yeah, it does get kind of confusing, and you wonder where that equity underwriting revenue comes from.
Right.
If you turn the page to the debt underwriting revenue, that's where the banks are making a load of money this quarter, and it's because you're still seeing people come to tap debt markets. They're just not coming to tap equity markets. But also, you're watching equity markets stand at sky highs. Is this the time to issue? I don't know, probably. But, you know, do people want to pay that much?
So let's talk about wealth management, not just because that's my day job, but it's kind of fascinating seeing them blow those numbers out of the water. Why was this a surprise considering, you know, markets at all-time highs? We literally finished the third quarter at a high print. Why did analysts not anticipate this?
Totally fair question, because they are also the biggest of the big, as you know. The interesting thing about Morgan Stanley is, yes, it's not only that they did well, it's that they did better than well. So not only is their wealth management revenue past expectations, it's the margin. So that margin in recent quarters, because they've been integrating deals, had been kind of up and down and kind of not all over the place, but kind of around analyst expectations. The margin today was healthily above what anyone expected, which shows you not only are they bringing in money, benefiting from those rising markets, but they're also keeping costs down to a significant degree, which is really the Morgan Stanley magic at this point.
Sonali, put it in perspective. We've got about 45 seconds. So here we are. This is pretty much what the tail end of the big banks, right? Nobody else to come. So the group overall, the outperformers, the underperformers.
You know, Citigroup was really interesting to see them be the biggest decliner yesterday in the KBW Bank Index.
Hammered.
And it's because people are asking a lot about whether they will eventually need an asset cap. And that's tough to be under that kind of regulatory environment. JP Morgan still came in blowing through the water, but I've got to say, coming into today, Morgan Stanley was actually trading at a higher price to book multiple than JP Morgan, which is just remarkable. If this trade holds, let's see how much more rich they are at the end of the day.
Yeah, we'll see. I mean, I got to say the stock bouncing around, I mean, gaining, but we're off our highs here in the pre-market, but still up about 2%. So appreciate it. Sonali Basak, catch her interview with the CEO of Morgan Stanley that's coming your way on Open Interest on Bloomberg TV. All right, folks, as we continue to watch Morgan, as I said, up about 2%. More to come right here on Bloomberg Surveillance, including the latest from the campaign trail. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Little movement in futures after more big bank earnings. Morgan Stanley, as our Sonali Basak just said, blew it out of the water, beating across the board for the third quarter. Shares right now, they're up about 2%. Heading over to futures. So we have NASDAQ futures up about 0.1%, 32 points. Dow futures up 11 points. S&P futures up about 3. The 2-year yield, 3.92%. That's down 2 basis points. The yield on the 10-year, 4.00%. And that is down about 2 basis points. To commodities, we have Brent crude $73 a barrel, WTI crude $70 a barrel, and checking with spot gold higher at $2,679 an ounce. Some deal-making news. Sources say Shein, or my daughter says Sheen. I still don't know which one it is.
I don't know either.
Exactly. It selected Barclays, UBS as book runners to help arrange its potential London IPO, and then Intel-backed Horizon Robotics seeking up to $696 million in its Hong Kong IPO. Order books are said to have been fully covered. And I thought this was interesting. Billionaire Ken Griffin's Chicago penthouse finally finds a buyer, but it comes at a loss. It's a 7,500 square foot unit. He's never lived in it. It was listed for $11 million back in July, less than $21 million that he paid for it back in 2017.
Nice to know that he can lose money on real estate, because I hear so many stories of people who are like they can't make money on real estate.
But that's not his core competency. So I think Ken's doing okay.
You think he is? He's doing
I think he'll get by. He'll get over this.
Maybe he's waiting for mortgage rates to go down. I don't know. What was he waiting for?
Who knows? Thanks, guys.
All right, Lisa Mateo there. Thank you so much. Hey, folks, this is Bloomberg Surveillance on this Wednesday, October 16th. Carol Massar along with Barry Ritholtz. We are in for Paul and Tom. Bloomberg Surveillance brought to you by Oppenheimer. Oppenheimer focuses the power of their thinking on you, creating customized plans to help achieve your goals. Put the power of Oppenheimer thinking into your investing. Call an Oppenheimer professional today. Hey, folks, I'm guessing the folks at Oppenheimer are watching those Morgan Stanley results, because that stock we are watching, it is definitely up here about 2.2% in the pre-market. I mean, jumping after results beat across the board. Total deposits above expectations. Net interest income above expectations. Compensation expenses coming in higher as well. Third quarter equities trading, that is above estimate. So really just across the board here, Barry.
And let's put that $7.5 trillion in wealth management into context. Vanguard is about $9.5 trillion. BlackRock is about $11.5 trillion.
Yeah.
They're in very elite company. They're in the top 10, probably top 5, if not top 3 of wealth managers. That's a giant number.
Yeah, so that's why we're watching that. We're also keeping the election and the race on our radar as well. On that, Donald Trump defending his plans to overhaul the U.S. economy through dramatic tariff increases and more direct consultation with the Fed. He caught up with John Micklethwait, our Bloomberg News editor-in-chief, in an interview at the Economic Club of Chicago, talked about something so important to the Bloomberg audience. We're talking about tariffs.
Because we're about growth. She's got no growth whatsoever, and we're all about growth. We're going to bring companies back to our country. You look at even today, as I was driving over, I see these empty, old, beautiful, like steel mills and factories that are empty and falling down. Some have been converted to senior citizens' homes, but that's not going to do the trick. And we're going to bring the companies back. We're going to lower taxes still further for companies that are going to make their product in the USA. We're going to protect those companies with strong tariffs, because I'm a believer in tariffs. I'm not sure that you are. I don't think you are, but I congratulate you on your career. But to me, the most beautiful word in the dictionary is tariff, and it's my favorite word. It needs a public relations firm to help it, but to me, it's the most beautiful word in the dictionary.
Tariffs, do you think that will bring in the revenues? To use another bipartisan group, Peterson Institute, they say they only bring in $200 billion. That is that's barely the cost of 2 of your promises.
Yeah, but that's like, for what company are you talking about, okay? Look, I've brought in with tariffs, and I was just getting started. Then COVID came, and we had because I tell you what, I did a very good job in COVID. Nobody knew what the hell it was. I call it the China virus because I like being a little more accurate. But when that came, but we got hundreds of billions of dollars just from China alone, and I hadn't even started yet. But tariffs are two things, if you look at it. Number one is for protection of the companies that we have here and the new companies that will move in, because we're going to have thousands of companies coming into this country. We're going to grow it like it's never grown before, and we're going to protect them when they come in, because we're not going to have somebody undercut them.
All right, of course, that is Donald Trump, former President Donald Trump, Republican presidential candidate, as you all know, speaking with our Bloomberg News editor-in-chief, John Micklethwait. That was yesterday at an interview in the Economic Club of Chicago. They talked tariffs, but they covered a lot of ground. Let's get to it with Kailey Leinz. She's co-host of Bloomberg's Balance of Power on Bloomberg Radio and Bloomberg Television. Kailey, I'm not quite sure where to begin. It was a long conversation. It took a while for it to begin. What stood out for you? The same that we've gotten from Mr. Trump on the campaign trail, or anything different?
There wasn't much new news in this interview, Carol. We have heard a lot of this language and these policy proposals already from Donald Trump over the course of his campaign, including his proclivity toward tariffs, his favorite word in the dictionary, as he said. He really pushed back against any idea that his tax policy would add to the deficit or that tariffs could add to inflation, which is what most economists would tell you will happen if these policies become reality. But he essentially said we can grow our way out of tax cuts. Tariff income can help offset some of the lost revenue from lower taxes. And again, most economists do push back on that. But it raises the question of the audience Donald Trump was really speaking to yesterday. There was obviously many people gathered in that room in Chicago, many of whom were clapping at his ideas, who like what he is saying, while some on Wall Street and financial markets may not like the idea of blanket tariffs put on China and what that could do to the U.S.-China trade relationship for an American worker, a manufacturing worker in the Rust Belt states like Michigan, Wisconsin, and Pennsylvania, which could help decide the election. It may be a message that is a bit more well received in those areas.
So Kailey, you hit on exactly the question I was going to ask. Given the near universal consensus that tariffs are a tax hike on consumers and are inflationary, who is in that audience applauding tariffs? I can't imagine it's the usual members of the Economic Club of Chicago, or am I completely misunderstanding their economic outlook?
Well, there were members of Chicago's business community that were there. There were also many people that are part of Trump's staff and campaign who were there. While we didn't get to see, an aerial shot of the room every single time the applause was going on to see how many people in the room were clapping, clearly there were people in there who are supportive of these ideas. Chicago, of course, is a Midwestern state. Manufacturing and bringing back American manufacturing, specifically maybe a more popular idea in some of these areas. And I would point out that is really what we heard Donald Trump say quite a few times, is that this is about bringing manufacturing back to the U.S., that he would like to put into place what he described as tariffs so obnoxious that they'll all come rushing in. Obviously, supply chains take much longer than immediacy to actually reroute themselves. Factories can take a long time to build, but that's kind of the premise here, making more in the U.S. And that is something that, at least to blue-collar voters, might sound pretty good.
So I know Chicago is in the Midwest, but when he presented his case to the Economic Club of New York, you heard very similar applause to lines that you typically think as very counter to economic consensus. So I'm just kind of fascinated. Who's in the room? Who's in the audience? Is this... I know that he did a town hall recently, and it was a very friendly audience. Who's in the Economic Club audience?
Well, they can bring people into the room so that are more friendly to Donald Trump, are well known or affiliated with his campaign. As you referenced his appearance at the New York Economic Club, there were people who actually were able to ask him questions on that stage who've been very supportive of his economic ideas and so I think there is the question of the kind of people Donald Trump is asking to be in that room, who is getting credentialed for these places, knowing that he does like to play to an audience that is in his favor. You saw a lot of that in that interview yesterday, where he was talking to the audience and kind of making jokes, trying to create these laugh lines, a lot of personality around it as he went through all of these various topics.
Yeah, well, certainly interesting, everything that we're seeing on the campaign trail on both sides. Kailey Leinz, thank you so much, host of Bloomberg's Balance of Power, of course, on the 2024 presidential race. But it is interesting. I think as they continue to, both candidates hit different media outlets, friendly audience, not friendly, the perception's different.
It's quite fascinating, especially we're going to see Harris on Fox News today. That'll be fascinating.
All I want to do is get to the day after the election. Little Sheryl Crow, I got to tell you, I've seen her live many times. Super fan. And we are living in interesting times, that's for sure. All right, everybody, this is Bloomberg Surveillance.
more money than God, right?
Geopolitics front and center for global Wall Street.
With Lisa Mateo on markets.
Stocks are coming off of another record high.
And Michael Barr with news.
U.S. Secretary of State discussed the conflict in Gaza.
The best in economics, finance, investment, and international relations. This is Bloomberg Surveillance on Bloomberg Radio.
And a very good morning, everybody. Yes, you are listening and watching on YouTube, on Bloomberg Radio, live in our Bloomberg Interactive Brokers studio. This is Bloomberg Surveillance for this Wednesday, October 16th. Tom and Paul are out, although Paul is on assignment, so you'll catch him a little bit later on Bloomberg Intelligence. Carol Massar, though, along with Barry Ritholtz, he is host of Masters in Business, broadcast and podcast, also his At the Money series. So good to have you here. He's, I don't know, you're looking at some financials over there, right?
Yeah, I was looking at the charts of how well Goldman Sachs has done over the past 20 years.
Pretty well,
and,
right?
Yeah, and you know, you see, we were talking about Citi earlier, you see the former brokers, Morgan Stanley and Goldman Sachs, both over their pre-financial crisis highs, both over their .com highs.
Okay.
A lot of the former big banks haven't quite reclaimed, pure banks, not Wall Street brokers that became banks.
Right.
The Wall Street business, it's riskier, but it's much more rewarding than staid, boring traditional banking.
Which is always amazing to me that they're still considered banks because they do so much more.
I
I know
mean-
it's from the crisis, but
Right,
nonetheless.
right. That temporary change turned out not to be so temporary.
Right.
And when you just look at their history versus Citi or some of the other Wells Fargo-like banks, it's just a tale of two different financial institutions.
That'll do it, right? When you can play in some other territories
Yes.
where you can make a bunch of money. All right, more to come certainly on the banks and others. Let's right now, though, get a check on what's coming ahead in our trading day. Let's get a Bloomberg Business News Flash with Lisa Mateo.
You got it. And right now, futures pretty much flat. Big bank earnings wrap up this morning. Morgan Stanley reporting a beat across the board. Its wealth management revenue came in above estimates. Right now, its shares, they're up about 3%. We'll be speaking with Morgan Stanley CEO Ted Pick at 10:30 Wall Street time, so be sure to tune in then. U.S. Bancorp lending income topped estimates in the third quarter. Shares up about 1.5%. After the bell, we'll hear from Discover. NASDAQ futures up 0.1%, 30 points. We have Dow futures up 29 points. S&P futures up about 5. The 2-year yield 3.92%, down 2 basis points. The yield on the 10-year 4.0%, and that's down about 2 basis points. Chip stocks, they're just battling to recover after a combined $420 billion in market value was erased. A big part of that, well, that was a profit warning from Dutch chip equipment maker ASML Holding. Shares down more than 3% in Europe. I want to check in with NVIDIA. They're right now up more than 0.5% after falling nearly 5% yesterday. And finally, shares of fashion retailer LVMH under pressure, down 4% in Paris after sales fell for the first time since the pandemic. That's Bloomberg Business Flash. Carol and Barry.
All right, Lisa, thank you so much. Lisa Mateo there. Carol Massar along with Barry Ritholtz live here in our Bloomberg Interactive Broker studio. I think it's interesting. I want to get to Anne Miletti because she's sharing some research with us about kind of the big picture for equities, but specifically, Barry, focusing on the election. It's the second person in about 2 days that has said to me, basically, should we be worried about the election outcome? What does it mean for investors? And historically, maybe it doesn't mean a lot, at least initially.
Yeah, we did a study going back to 1950, and if you only had money in the market, if you put a dollar in the market in 1950, kept it there when Republicans had the White House, it grew to $30, kept it there when Democrats had the White House, it grew to $100, kept it in the whole time, it's $3,000. So if you allow your politics to get in the way of your portfolio, you're really asking for trouble.
So kind of ride it out. All right, so let's see what Anne Miletti has to say. She's head of equity over at Allspring Global Investments, joining us on this Wednesday. Hey, Anne, great to be checking in with you again. Let's start with the election. You looked into it, wrote a paper on it. How are you thinking about what investors should or shouldn't be doing when it comes to the U.S. presidential election?
Well, I think you summarized it really well, Carol. Look, investors, we're all human beings, and we get fearful of change, and especially when it's in our face every day. I live in a swing state in Wisconsin. There's polarization happening around what each of the policies for, the Republican candidate or the Republican candidate, the Democrat or the Republican candidate could produce. But the reality is history does suggest equities can continue to do well through either administration. And likely it's also because it's not just the president who determines these things. It's also because the Senate and the House do make a big difference as well.
And we keep talking about that. What happens in those down ballot races, particularly what happens in Congress, is important to what a president can get done. Having said that, we are spending so much time, Ann, talking about John Micklethwait, editor-in-chief of Bloomberg News, sitting down with Donald Trump. Donald Trump talked a lot about tariffs. We've done some of the research about what tariffs across the board, whether it's China or even other some of our allies, as Trump has talked about, what it would mean in terms of the impact on the U.S. economy. If that happens and we have a second term by a Trump White House, would that change your thinking about what that might mean for some companies here in the U.S. and how some equities trade?
Look, either administration could have an impact on individual companies, but we know that they will adjust. I think this tariff issue is an interesting one because two things could be true. Tariffs could increase inflation and have increased some challenges for some companies, but maybe if you do get growth alongside of it, you don't feel that. And I think that's one of the most important things that I've learned in my career in the equity markets is that you can't look at things in isolation. Even when we're looking at economic data, there's no one set of data that really will kind of rule the forward path. It's a collective sets of data. And so we tend to look at these things in silos, like what would happen with the tariffs. I think it's what would happen with tariffs, what would happen with the growth rate, what would happen with all of these things, and what is the impact ultimately on companies that are trying to manage through it. And I think the reality is that companies typically do adjust and find ways of adjusting to a new set of rules. Sometimes it takes a little bit of time, but they typically do adjust, which again leads to the outperformance that Barry also talked about at the initial outset.
So Ann, I want to throw out a contrarian idea and get your response to it. Okay. People have been talking about this election like it's a big change election, but can't we say either we're going to get a second Trump term, which isn't going to look very different than the first Trump term, or a first Harris term where there isn't going to be a whole lot of daylight between her and Biden? I know she's trying to cut her own course, but isn't this just choosing between one former incumbent or the other? How big of a change election can this be?
I actually think that's a really interesting point. A couple of months ago when I was on the show, I had talked about this too, Barry. I think these are kind of two known entities in terms of what the potential outcome could be. It is very likely that Trump 2.0 will be similar with his policies and what we saw with his first term. It also is very likely that although Harris would like to cut her own path, you will see some of the same policies that we've seen over the last 4 years. So despite all of the drama out there and uncertainty, these are known entities. And we haven't had an election where both sides are so well known.
So let's stay with this theme and look forward. If we kind of get a sense of what we're going to get with either candidate, I want to focus your discussion on quality and moving down the market cap size into mid and small cap. Does that matter who gets elected, or is that just broad allocation regardless of the 2024 presidential election outcome?
I actually think it's regardless of the election outcome. Again, I don't want to look at anything in a vacuum, so there's always some relation to bigger picture issues. But one of the things that we've seen over the past several years is this increased concentration into the large cap space. Now, as you know, fundamentals have driven that. Earnings growth, revenue growth has been higher, substantially higher in some of those large cap companies. But now index investors, passive index investors in particular, are taking very concentrated bets when they're investing in a straight S&P 500 index, for example. And it becomes not only more difficult for those large cap companies to grow, but there's also more scrutiny for those large cap companies. I mean, today we see 43% of the S&P 500 is under antitrust investigation, which is interesting and may not mean a whole lot.
I'm sure they feel there's a different word rather than interesting. That's right. For those on the radar.
That's right. And it may not mean a lot in the near term. We all know these things get caught up in court and other things, but it also likely hampers the management's ability to be as flexible as they'd like to be.
And I will say, Donald Trump was asked about Google and the cases or the government case against Google. So something that we know will continue into probably whatever administration, or maybe not. Maybe it'll calm down a little bit. And great stuff, as always. Anne Miletti, be well, head of equity over at Allspring Global Investments, joining us on this Wednesday. Hey, folks, let's get back to world and national news. A lot going on around the world. Michael Barr is back with that. Michael.
Thank you very much, Carol, Barry, Lisa. With just 20 days to go until Election Day, both campaigns are hard at work getting their messages out. Former President Trump spent a part of his day talking to business leaders at the Economic Club of Chicago in a conversation moderated by Bloomberg's editor-in-chief, John Micklethwait. Trump defended his plans to overhaul the U.S. economy through dramatic tariff increases, arguing that his policies would result in substantial growth, despite projections that his agenda would fuel inflation and spike the national debt.
You're flooding the thing with giving giveaways.
But we're going to grow.
I was actually quite kind to you. I used 7 trillion. The upper estimate is 15 trillion. People like the Wall Street Journal, who's hardly a communist organization,
yeah, but you don't know.
They have criticized you on this as well. You are running up enormous debts.
What does the Wall Street Journal know? I'm meeting with them tomorrow. What does the Wall Street Journal know? They've been wrong about everything. So have you.
Vice President Harris is addressing the economic disparities that exist in the black community. While on The Breakfast Club with Charlemagne the God in Detroit, she mentioned the illegal practice of denying loans to people based on their race.
We have a history of a number of things, including redlining. Detroit knows it well. A history of, for example, something that still exists that I've worked on to address, which is racial bias in home appraisals.
Today, Harris will do an interview with Fox. Ukrainian President Volodymyr Zelensky unveiled a blueprint for his country's victory in the war against Russia. The plan presented to Parliament today is considered by many as Ukraine's last resort to strengthen its hand in any future ceasefire negotiations with Russia. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr. This is Bloomberg. Carol, Barry, Lisa.
All right. Show of hands, guys. How many hear Breakfast Club and you think of the movie with Molly Ringwald and Anthony Michael Hall and Paul Gleason? Yes. I don't think of... All right. I mean...
That last scene is
I'm
just
not saying
seminal.
We're old, but that's all I can think about. Every time I hear it, I'm like,
I think
that's
about,
what I think of.
what is it, the one where she scratches her head and the dandruff is coming out all over the table? Now let's have breakfast.
So that's nothing to do with Kamala Harris, right?
No.
Nothing to do with that. All right, just want to set the record straight. We're not old. We're just seasoned or something like that.
No, we're old. You can say it. There's nothing wrong with it. Age brings wisdom. It's fine.
Yeah. Okay.
It's like vintage. It's good.
That's right.
I do like vintage. All right, everybody. This is Bloomberg Surveillance on Bloomberg Radio.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
In the Bloomberg Interactive Brokers Studio, I'm Lisa Mateo. Futures pretty much treading water this after big bank earnings wrap up. Right now, Morgan Stanley shares, checking with them, they're up about 3%. We have NASDAQ futures up 0.1%, 20 points. Dow futures up 29 points. S&P futures up about 3. We have the 2-year yield 3.92%. That's down 2 basis points. The yield on the 10-year 4.0%, and that's down about 2 basis points. To commodities, Brent crude $74 a barrel. WTI crude $70 a barrel. We have spot gold higher at $2,678 an ounce. More economic data out this morning. MBA says mortgage rates rose sharply for a second week in a row, climbing 6.52% for a 30-year fixed mortgage. That's the highest since early August. That pushed applications for mortgages down about 17% last week. More data to come in 15 minutes. We'll get a read on import prices. Tomorrow, retail sales. We'll keep an eye on that. Companies making news. That's Qualcomm. Sources say it'll probably wait until after the U.S. election before deciding on a takeover of Intel. And General Motors committing $625 million toward what's likely to be one of the biggest U.S. lithium mines. And finally, sources say Airbus. It plans to cut about 2,500 jobs at its space and defense unit. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash. Carol and Barry.
Lisa, thank you so much. Carol Massar, along with Barry Ritholtz, live here in our Bloomberg Interactive Broker Studio on Bloomberg Surveillance. Tom and Paul are off today. Paul, of course, coming up a little bit later on Bloomberg Radio. Just to remind everybody, that last jobs report for the month of September, Barry, U.S. job growth last month, topping all estimates. The unemployment rate unexpectedly declined. Wage growth accelerated, reducing the odds the Fed will opt for another big interest rate cut in November. That report, I remember breaking it down with Michael McKee saying everything just seemed to be good.
Yeah, you could say that, but I have to point out. No, everything is fine. I just am always aware of the recency effect and our over-focus on whatever the last data point is. Look, 3 million people change jobs, leave a job, retire, shuffle off this mortal coil, and another 3 million people come in, start a new job, whatever, graduate, and the net difference between those numbers is the non-farm payroll out of 161 million people. So I can't get 250 versus one.
You don't get that excited.
Versus 210 out of 161 million is a rounding error.
All right, let's see what Lakshman Achuthan has to say about that. Founder of course, the Economic Cycle Research Institute, based here in New York City, ECRI. He is right now, though, in our Bloomberg Interactive Broker Studio.
And his leading economic indicators is one of my favorite economic data points.
Well, that's what I was going to say. He knows data really well, lots of data. And it's accurate in terms of you think of where you were over the summer and what's played out. How are you?
I'm well. It's so good to see you guys. And I think the points that you're making are spot on. Right? It's surprising, I think, people when they saw that employment report. And Barry, your point is exactly spot on, as it often is.
I learned from the best.
All right, we're good. That was so happy. We're done. We're done.
You know, so the whole thing we're doing is monitoring cycles, economic cycles, cycles in growth, cycles in employment, cycles in inflation, and no one data point is good. They're all really faulty.
Right.
So we use indexes. We spent a lot of time, decades, dare I say 3 generations, putting together groups of indicators that give us a little bit of a heads up if there's a directional change. And so, Barry, I remember you and I were talking last April. We were doing your master's in business, and I was saying, hey, the window of vulnerability, the cyclical window of vulnerability is closing. There's a whole bunch of reasons we can tell the story in the data, but the risk of a hard landing isn't really there. And you know, in the summer, people got really excited. Hey, is there a recession? All this stuff. And lo and behold, we're hanging in there. We're slowing down, but we're not crashing. And, you know, it's kind of a little Goldilocks at the moment. Not too hot, not too cold.
Do we have to have a landing of some sort at some point? They are cycles. They have highs. They have lows.
You do. You absolutely do. The question is it hard or soft? And right now, it looks decidedly soft. As far as we can see. We can't see that far. I don't want to say we know what's going to happen down the line, but for everything that we're monitoring and managing cycle risk, now's not the time to play super duper defense.
Right. You said something that has stayed with me for a long time. I want to say 2013, 2014, we were talking about, we were still suffering a little PTSD post-crisis, and a lot of people then were forecasting recessions. And one of the things that has always stayed with me is the economy. Think of someone walking down the street and you get bumped or jostled. A steady, healthy person, a running back, is going to keep their feet. For one of these surprises, one of these shocks to cause recession, you need a weakened economy that's very vulnerable. Talk a little bit about how strong or weak the overall state of the economy is.
Right, so that's your cyclical vulnerability. I've said over the years, people who have listened to us, we talk about a window of vulnerability, a weakened immune system. They're in a free market-oriented economy, and we've studied them all over the place for a very long time. There are cycles, ebbs and flows. There's times when your immune system is strong and times when it's weak, or when you're off kilter. When you're off kilter, almost any shock can be a recessionary shock. When you're standing firm, you can take a hit and keep on going. Remember Katrina, we're in a hurricane season.
Yeah.
And when Katrina hit, a lot of people said, oh, that's recessionary. A quarter of the economy shut down for a minute. And lo and behold, there was no cyclical vulnerability, and we walked through it. Here, we've got some hurricanes. What's going on? We're going to get jumpiness in the data. I guarantee you it's going to happen. Maybe someone will run with it and say it means this and it means that. When you look at the composite indexes, that tells you a little bit clearer picture. And right now, even though we're likely to get some ups and downs here, it's steady as she goes. And all the activity that gets hit during the hurricanes, on the other side, you're going to have rebuilding. And I got to tell you, one of the sectors that's been a bulwark here has been the construction sector, non-residential construction. Now I bet residential construction comes back in.
So the one question I keep asking people and not getting a satisfactory answer is, why did,
no pressure,
given that, but you're the right person to ask this, given that window of vulnerability, why did so many economists so expect a recession that never showed up?
Remember how many interest rate cuts they were thinking at the end of last year? They thought,
last year, the year before also.
Okay,
recession they've been talking about forever. Feels like
so
a couple last
all right,
years.
I think the fundamental reason is labor hoarding. Now we're talking post-COVID stuff, right?
Right.
So we're coming off, we got rate hikes going like crazy, and we've got a big slowdown, and everything's cyclical. Anything discretionary was slowing down. Even employment was coming down. The growth in the cyclical discretionary parts of the economy was slowing really, really hard. However, the non-discretionary, think teachers, think doctors and nurses, okay? That employment component, which is a lot of people, was running near 3-decade highs in its growth rate. It was solid, and it was so structurally difficult to get recessionary declines in employment, even with the big cyclical slowdown. I think that labor hoarding continues today. The only reason we're having some slowdown in jobs growth right now is because that non-discretionary component of the jobs market is slowing. It's coming off of crazy 3-decade highs.
Yeah.
And the cyclical component, the discretionary component, I think it's actually troughing.
So, Lakshman, do you get upset or nervous if we we don't see that labor hoarding anymore, and if we start to see layoffs? We haven't seen a lot of. If we start to see that,
sure, layoffs. I think layoffs I would take as seriously as someone who got laid off. Okay, those are serious things. We don't see them here. Jobless claims are a great thing to look at. We have the
Boeing or the Airbus that we talked about this morning,
these are one-off. These are company specific. Yeah. I don't see, you used PTSD before. There's so much PTSD about that difficulty in hiring post-COVID.
Right.
And there's no hard landing here.
People are still stung. Companies are still stung from that.
Look, it's very expensive to let someone go and then hire them back again.
And there's a shortage of workers out there.
100%. And so we have a whole, there's demographic things going on. We can get into that. But the long and short of it is, to your point, Carol, I don't see the recessionary level job losses in front of us. Look, that could change. I don't know what's happening in a couple of quarters. I do want to make one last point.
Quick. 10 seconds.
Going into 2016 election and 2020 election, leading indicators were firming as they are now.
Really cool stuff.
All right.
So much fun to reconnect. Lakshman Achuthan, of course, of ECRI. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Futures still steady right now after Morgan Stanley reported a beat across the board. Shares right now, they're up about 3%. We have NASDAQ futures up 19 points, Dow futures up 31. We have S&P futures up 4. The 2-year yield at 3.92%, that's down 2 basis points. The yield on the 10-year 4.01%, and that's down 1 basis point. To currencies, we have the dollar weaker, Japanese yen weaker, euro stronger, British pound weaker. The pound actually tumbled below 130 after UK inflation slowed below the BOE's 2% target for the first time in 3.5 years, right now at 130.34 against the dollar. Bitcoin up 2% at around 67,000. Abbott Laboratories, well, it beat Wall Street estimates for quarterly earnings and sales, but it just was enough to lift shares. The shares are down now about 1%. United Airlines reported third quarter profit ahead of Wall Street expectations. Their shares up about 1%. And European budget carrier Ryanair says the strike at Boeing, well, it's compounded aircraft delivery delays affecting the outlook for passenger growth next year. Their ADR is down about 1%. That's a Bloomberg Business Flash. Carol and Barry.
All right, so appreciate it. Lisa Mateo there with a Bloomberg Business News Flash. Carol Massar along with Barry Ritholtz. We are in for Tom and Paul here on Bloomberg Surveillance, live in our Bloomberg Interactive Brokers studio. We are on YouTube and, of course, on Bloomberg Radio. Hey, Barry, I don't know if you saw this story, but it had to do with U.S. consumer delinquency fears. And here's what this came out from the New York Fed. It's their monthly survey of consumer expectations. It was a rise driven by middle-aged respondents. What it was, though, is that perceptions among American households that they might become delinquent on debts increased last month to the highest level since April of 2020. And the anticipated probability of missing a minimum debt payment over the next 3 months rose to 14.2% in September. It was the fourth straight month of increases. Again, a New York Fed monthly survey.
Yeah,
That's not good.
Yes, but everything is a yes, but. When you ask people to predict what they're going to do in the future
versus what they do,
what they actually do, when people say I'm worried about defaulting, that typically means they're aware of the problem and they're not going to default. It's when nobody is worried about defaulting that you run into trouble. People aren't paying attention to it. So,
which kind of makes sense, right? If you're aware of it, you're going to, but you might then cut back on spending, right? So it does potentially have an economic impact.
When I think the biggest motivation of the Fed in beginning their rate cutting cycle is when you look at the bottom half of the economic strata, they're suffering from high rates that are making automobile borrowing more expensive, credit card debt more expensive. We won't even talk about housing, but it's not a surprise that this big uptick, 525 basis points higher, you're going to start to see some economic pressure amongst the, pick a slice, bottom half, bottom quartile. So it makes some sense. That's part of the motivation as to why we're easing.
Yeah, exactly. All right, so let's get into it. Let's see what our next guest has to say about the U.S. economy. Lydia Basour is senior economist at EY Parthenon, joining us here. Lydia, this consumer delinquency fears, as Barry mentioned, there are things you think or things you say, and then there are things that you do. So how are you seeing it in terms of the consumer, the U.S. consumer? Is it under stress, and will that have some economic implications?
Yeah, good morning. So I think it's important to highlight these data because they really show that there's just not one consumer. If you look at the overall broad picture for the consumer, we've seen solid consumer spending growth in the second quarter. It looks like consumer spending growth is going to be, again, solid in the third quarter, tracking at around 3%. But there is, a lot of nuances if you look beneath those headline numbers. There is really a bifurcation and a polarization among households. We have higher income households that are, spending freely and that are benefiting from those wealth effects. And at the same time, those lower income, middle income households that are feeling the pinch, as you were saying, from higher interest rates, from elevated inflation. And we've seen those delinquency rates actually already rising for auto loans, for credit cards. So there is some pressure when you look beneath, those aggregate numbers, and there is really higher income households pushing that spending momentum and lower income households feeling the pinch from those economic challenges and the softer labor market as well.
So you have an interesting note out on Hurricane Milton's economic impact. How significant, it's not just Milton, but it's Helene, and before that over the summer, Hurricane Debbie did a lot of damage. How destructive has this season's hurricanes been, and what does it mean not just to the local southeast of the United States economy, but the whole nation?
Yeah, so, in terms of the economic impact of the hurricanes, we're likely to see, some impact on Q4 GDP. We think a few tenths of GDP might be impacted by the hurricanes. We're likely to see more, blurriness in the data. That's also important in the context of, the Fed and the next rate cut. We've got, we're going to get, we know historically that hurricanes disrupt the data. We're going to see some impact. We've already seen some impact on employment data, on jobless claims. The next jobs report also is going to show some impact as well. So we're going to get some disruptions in terms of the economic data points that the Fed is really closely looking at. And that's going to create a challenge in terms of really gauging the underlying trend of the economy in the coming weeks.
So if we were to go back in time 10 or 20 years and there would be a hurricane that did some damage in Florida, everyone would rebuild. No one would think twice about it. They would get insurance and go on with their lives. I'm getting the sense
That's
around
not today,
the edges that there are people who are second-guessing, relocating from the Northeast right into Hurricane Alley. We're starting to see signs that prices have peaked and reversed in terms of real estate, and then getting either flood insurance or general insurance has just become crazy expensive in Florida. How are you looking at this? Is the shift from the rest of the country to the Sun Belt ongoing, or has that maxed out? And again, what does that mean for the broader economy?
Yeah, so I mean, in terms of the impact on the regional economies, we're going to see a lot of disruptions. We've seen economic losses. We're going to get some rebuilding. Now, this is not necessarily going to be translating into GDP. What we're going to see in terms of GDP essentially is just a temporary hit, and then we're likely to see no long-lasting impact in terms of overall economic activity. But at the regional, at the local level, it's going to take some time for that rebuilding to happen, and then for some of these disruptions at the local level to fade away, and for the economy to get back on its feet.
Lydia, that makes me, just to build on what Barry said, whether it's climate change, demographics, geopolitics, reshoring, nearshoring, it does feel like that there are some macro issues going on that might change, that are changing kind of the dynamics for what our economy looks like, what our investment environment looks like going forward. And I just wonder if you agree, and that shift and what that means going forward.
Yeah, I mean, there is
and so on. Yeah,
we've been talking about this new normal for the economy, and I think one important area of this new normal post-pandemic is the fact that we're likely to see more supply disruption, and that the supply side of the economy has become a lot more important for businesses to think about in terms of business strategies. We've seen how disruptions on the geopolitical front with increased geopolitical tensions and the war in Ukraine. Also, natural disasters and disasters, the pandemic, we're looking at hurricanes, how all of these can disrupt, the supply and create some of these shifts. So that's something that's going to be very important to think about, and that we talk about to our clients at EY in terms of, building more resilience in supply chain and thinking about these changes. And there is, obviously, you talked about some of these structural changes. There is also this idea that perhaps, inflation is also going to settle somewhat higher than the Fed's 2% target because of some of these factors likely to create some upward pressure on inflation. We have, decarbonization. We have, higher deficits. We have demographics. So all of these factors do point to also some more inflation pressures in the long run.
And I was thinking of, and forgive me, I was just looking at my notes here, because it was Lisa Abramowitz who talked with JP Morgan CEO Jamie Dimon. It might have been Jamie who said that demographics, all these things are kind of inflationary, at least near term, and that you do think about that higher trend line. And what does that mean? And what does that, higher inflation environment, how it eats into investments too, that will change the composition going forward, potentially.
Yeah, I mean, in terms of inflation, I think, when we think about some of these factors, we really think about more of the medium to long run. I think if you look at the environment today, and that's the distinction that we make, we're still seeing ongoing disinflation. And when you look at some of the underlying factors and underlying drivers of inflation, we do think that, a few months down the road, when you look at, the outlook for 2025, we do expect to see inflation continuing to move lower. And that's because the key factors and some of the fundamental drivers of inflation, such as pricing power, you look at demand, consumer demand, and more price sensitivity. Pricing power has come down, markups have come down, the labor market has rebalanced. So all of these factors do suggest that inflation is going to move lower as we head into 2025. So going back to the Fed, I think there is room for more recalibration because inflation is still trending down and because we're seeing that softening in the labor market.
All right. Going to leave it there. Hey, Lydia, thank you so much. Lydia Bassor, she is senior economist at EY Parthenon, joining us right here on Surveillance. All right, time to get another check on world and national news. That means it's time to head over to Michael Barr. Michael.
Thank you very much, Carol, Barry, Lisa. With 20 days to go until Election Day, both campaigns are hard at work getting their messages out. Former President Trump talked with Bloomberg's editor-in-chief, John Micklethwait.
Can you say yes or no whether you have talked to Vladimir Putin since you stopped being president?
Well, I don't comment on that, but I will tell you that if I did, it's a smart thing.
Trump also defended his plans to overhaul the U.S. economy through dramatic tariff increases and more direct consultation with the Federal Reserve. Trump argued that his policies would result in substantial growth. Rebecca Patterson, former chief investment strategist at Bridgewater Associates, says Trump tried this on a smaller scale in his previous term in office, and it led to job losses in manufacturing and a slowdown in foreign direct investment.
I'm skeptical that repeating that process and doing it on a bigger scale with the risk of more retaliation is going to achieve anything different. So I appreciate that he wants to increase manufacturing jobs, but I don't think these policies are the way to do it. I think they're going to backfire and actually lift inflation and weigh on growth.
Rebecca Patterson at Bridgewater Associates. Vice President Harris wants to legalize recreational pot on a national level. While on the Breakfast Club with Charlemagne the God, Harris says she was against harsh penalties for weed crimes when she was the San Francisco DA.
I was the most progressive prosecutor in California on marijuana cases and would not send people to jail for simple possession of weed.
Today, Harris will be interviewed on Fox. The U.S. Supreme Court has ordered an appeals court to review its ruling that a law barring 18 to 20-year-olds from carrying firearms in public during a state of emergency is unconstitutional. The appeals court ruled the Pennsylvania law violates the Second Amendment, but in June, the High Court ruled that some gun restrictions are legal. Global news 24 hours a day, and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Carol, Barry, Lisa.
All right, thank you so much. Really appreciate it. Michael Barr, of course, with World and National News. Just thinking about what we're going to dig into with Joe Weisenthal and Tracy Alloway. Looks like they're looking at China a little bit.
That's always fun. You know, China has been practically uninvestable for the better part of 2 decades. It's amazing to think they are 17 years from their all-time high and about 40-something% below that peak. That's an astonishing data point when you consider the 20 years prior to that, they were just unstoppable, at least their capital markets.
I always kind of say to everybody, when I began my business news career a couple of decades ago, it was all about being in China, and you definitely see kind of a narrative reset. So we're going to dig into that in just a moment. You are listening and watching Bloomberg Surveillance.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Little movement in futures after Morgan Stanley beats, extending a run of positive reports by lenders. Right now, its shares up more than 2.5%. NASDAQ futures up 2 points. We have Dow futures up about 5. S&P futures are little changed. We have the 2-year yield, 3.94%. That's little changed. The yield on the 10-year, 4.02%, and that is little changed as well. To commodities, point out Brent crude, $74 a barrel. WTI crude, $70 a barrel. And checking with spot gold higher, $2,680 an ounce. Some deal-making news. Japanese entertainment conglomerate Toho, it's best known for Godzilla franchise. It'll acquire New York-based animation distributor G-Kids. It's a push to expand beyond its home market. And shareholder Artisan Partners International Value Team, it says Seven and I, it should enter talks with Couche-Tard and seek a price that maximizes value. And this story stood out to me. It looks like Las Vegas won't be the only location for the Sphere. Abu Dhabi's Department of Culture, Tourism, and Sphere Entertainment announced it's coming to the United Arab Emirates.
Of course it is.
I have not been to the Sphere.
I have not either. No, but I thought that they were going to, I think an analyst kind of weighed in on the upbeat kind of outlook of the company that's in charge of it because they expected them to expand.
And they are.
I want to go. Have you gone, Perry?
So I was in Vegas for a conference last December, and it was like a 4-day blackout for U2.
Yeah.
I got there the day after their last show, and I left the day before. Their next show, I was very disappointed. Everything I hear is just, it's wild.
It's just like the way to see something, right? How cool is it?
Yeah, yeah.
Like, totally
And
immersive.
20 years from now, there's going to be a Sphere in dozens of cities. It just seems like inevitable.
Right. The next step in terms of experience. All right, Lisa, thank you so much. Really appreciate it. I was going to talk to you about Godzilla, which I grew up with my baby brother watching Godzilla and Mothra. They would have the week of kind of Godzilla movies. I'm embarrassed to say that. She's got nothing. Did you ever watch Godzilla?
Of course. It was a deep commentary on the Cold War and the abuse of nuclear weapons.
Totally.
It's kind of fascinating.
The political, themes underneath it. All right, somebody and two folks, actually, who really get into the themes of our world, economic, market, business-wise, are the hosts of the Odd Lots podcast, Joe Weisenthal and Tracy Alloway. They are in the house in our Bloomberg Interactive Broker studio. Hello.
Hello.
What's top of mind for you guys? Any thoughts, first of all, on the Trump interview?
It was definitely an interesting one. I've seen very polarized opinions on Trump's performance, but I guess that's expected in basically every Trump interview. But in terms of what's top of mind for us, we have a really good episode coming out tomorrow on the big stimulus announcements that we've seen from China. Yeah. And we really spoke to two perfect guests for this. We talked to Nomura's Richard Koo, who, as you know, is the guy who basically came up with the balance sheet recession idea, and plenty of people think that China is now in a balance sheet recession, and there's some evidence of that if you look at the contraction in bank lending that they reported recently. And we also spoke with Zichen Wang. He is the author of the Peaconology Substack, and he's really good to talk to about the sort of technical details of Chinese policy making. He used to work at Xinhua. He's very good at spotting the players and the patterns that are sort of shifting right now.
Yeah, it was really fun. By the way, just on the Trump interview before we move on totally, can I just say
I knew you wanted to say something.
Can I just say I loved his line about how everyone thinks the central bank chair is a god, but really they just show up for 8 meetings.
Flip a coin.
8 meetings a year and flip a coin, because it's like...
Jay Powell's like,
it does,
not exactly.
Kind of seems like
I thought that was such a telling answer, because if you're a Trump fan, you applaud, and if you're skeptical of Trumpism, you go, this guy does not understand anything about monetary policy.
Look, actually, 8 meetings a year, and most of the time you're just holding rates. It doesn't seem like that hard of a job.
They do a lot.
You have all these economists on staff and other Fed governors and presidents.
This is Joe making his pitch for Fed chairman.
Yeah, that's right.
I could do it.
But so on the episode we have about tomorrow, one of the things that I think gets lost in the discourse about China is we think about it as this very unitary state and a command economy and what Xi Jinping wants, Xi Jinping gets, etc. And, things are, even in a system like that, extremely complicated and decentralized. And there are different entities that carry out policy, et cetera. And so, it's not all top down, especially on the execution. So it's a chance to sort of listeners realize it's a chance to sort of dive into like the richness of the debate that happens there and the complications of carrying out policy once the government decides that something needs to be done about declining growth.
So let's talk about that, because it's really an amazing topic. For 20 years, that richness of what was going on, for 20 years it felt like China's industrial policy could do no wrong. They were influencing the entire world, and
everybody wanted a piece of it.
Right. And then go back 15 years, even before the financial crisis, and it seemed like they lost the thread. They started building these giant ghost cities. Their influence and their investments around the world seemed to have waned, and suddenly all their internals became really problematic. Is China, I know this sounds ridiculous, is China essentially a paper tiger? What's really going on in the economy there?
Oh, this is the funny thing about talking about China is it's always like this massive threat that's hovering in the background and is going to devour everyone else's economy. But at the same time, there are people out there who also think it's like riddled with existential weakness. I do think like what's really interesting about the current moment in time is there is introspection on the part of Chinese policymakers about what they got wrong. I think there's a generalized sense right now that, for instance, the 3 red lines policy that they enacted a few years ago to sort of reform the property market, that might have been a mistake, right? Like, real estate prices crashed, and now in September you see them doing the exact opposite, which is turning back on the spigots for mortgage lending.
I think too really there's this deep contradiction with China that on the one hand, electric vehicles, batteries, solar power, airplanes, semiconductors, they're either at the cutting edge or rising. And you have to figure the country that is at the technological and scientific cutting edge of the world will be a rich country. On the other hand, they had this very like real estate asset heavy economy that's sputtering, and that's where people's balance sheets are. And so it gets back to the balance sheet recession. And there's only so much you can do to let that weaken in pursuit of these other things before they sort of have to pivot. And so the question is, can they smooth the decline of the asset part of the economy while also maintaining the momentum on the investment, tech, and export side? Or are these fundamentally in contradiction? And I think that's what we're going to see right now.
Well, you're going right where I wanted to go. Why are these mutually exclusive? Shouldn't you be able to have a robust business sector as well as a healthy housing sector? That's the strength here in the U.S. Why can't China do that also?
I mean, I think some people would say that like the strength of the U.S. housing sector is a constraint on economic growth, in the sense that some of our biggest economic centers in the U.S., San Francisco, New York City, et cetera, places where people would go to have productive jobs, are some of the least affordable, which is not ideal, right?
But that's a supply issue. China's problem is an oversupply of housing. With over 1 billion people, with 340 million people, we have an undersupply of housing.
Tracy, why don't you answer?
Or we can go somewhere else.
Okay, here's what I would say to that. Like you're talking about mobility, right? And like fostering an environment for innovation. There are some signs that there's movement on that. They've been talking about hukou reform for, a couple years now, and it seems like that might be getting serious. That's the idea. They have like internal passports. So if you live in the countryside, you have to get a permit to move to the city. And lots of people who currently live in cities are there technically illegally. So if you make that legal, suddenly you get more people going into the cities, more demand for housing, maybe, more innovation, new companies started, that sort of thing. So there is some movement. I think the thorniest political question that feeds into the trajectory of China's economy is what are they going to do on the social safety net? Because this is, again, like where you get that spending and investment problem, which is Chinese traditionally have saved an enormous amount of money because they can't rely on the government for things like retirement payments.
Yeah. And I also think there's that big question of, what do they want to be kind of in the global economy? I think we all thought 20 years ago, 25 years ago, they wanted to be a much more capitalistic society. And the rules constantly change. And I think for investors, that makes it awfully tricky.
By the way, this is the first conversation about China we've had where we haven't talked about demographics. It always comes up.
That's also... the other thing on when you say capitalist society, like one thing that clearly seems to be different is there's a lot of competition there. You know, there are companies and there's a stock market, et cetera. It does not feel like the stock market is as big of a deal as I mean, the stock market in the U.S. is how people pay for their retirement, right?
Right, that's right.
As you know, Barry. But, you know, it's not the same. It's not the same.
We got to run. Never enough time with you guys. Joe Weisenthal,
Thank
Tracy
you.
Alloway. They're the hosts of the Odd Lots podcast. Check it out wherever you get your podcasts. Also, just check it out at Bloomberg.com. All right, we're heading to a break, guys. More to come. The Open just 30 minutes away right here on Bloomberg Surveillance. A little breakfast club. Bloomberg Surveillance brought to you by Anshin Accountants and Advisors. Partner-owned since 1923, Anshin factors in your unique circumstances to develop innovative tax and accounting solutions. Visit anchin.com. Reevaluating possible.
This is Bloomberg Surveillance with Tom Keene and Paul Sweeney.
Why are we upset if we're creating jobs?
Inflation is still a thing out there for the everyday consumer.
With Lisa Mateo on markets.
The economic calendar jam-packed today.
And Michael Barr with news.
Tensions between the U.S. and China have heated up even more.
The best in economics, finance, investment, and international relations. This is Bloomberg Surveillance on Bloomberg Radio.
All right, everybody, we are less than 30 minutes away from the opening bell on this Wednesday, October 16th. Good morning. Good morning. It is Bloomberg Surveillance. I'm Carol Massar, along with Barry Ritholtz, in for Tom Keene and Paul Sweeney. Paul will be along a little bit later on Bloomberg Intelligence. We're live in our Bloomberg Interactive Brokers studio. We are on YouTube, and we are, of course, on Bloomberg Radio. Barry, I don't know. What are you looking at?
I'm still kind of fascinated by the Morgan Stanley earnings, and it'll be interesting to see how markets trade today. 3 weeks out from
Stocks
the election,
up 4% in the pre-market.
Yeah,
here.
Historically, a rallying S&P 500 is good for the party in power, but I have no sense of what this election is going to end up looking like.
I'm just going to say it's a super, super close one. And I think exactly, I don't think we know what the outcome is. And I don't know that we'll have an outcome by the end of election night, whether it'll be so close that we'll still have some votes being counted, whether it's for 24 hours or a couple of days. We will see. But in the meantime, there's a fair amount of stuff going on. So let's check in on some of your top business stories, what to look out for when trading gets underway. Let's turn things over to Lisa Mateo.
You got it. In futures, still pretty much flat. Big bank earnings wrap up this morning. Morgan Stanley reported that beat across the board. Shares right now up more than 3.5%. We'll be speaking with Morgan Stanley CEO Ted Pick at 10:30 Wall Street time. Be sure to tune in for that. U.S. Bancorp's lending income topped estimates in the third quarter. Their shares up more than 2%. Synchrony Financial, they're up nearly 4% after reporting earnings per share for the third quarter. That also beat estimates. After the bell, we'll hear from Discover. Right now, NASDAQ futures up 18 points. Dow futures up 10. S&P futures up 2. We have the 2-year yield, 3.94%. That's little change. The yield on the 10-year, 4.02%. And that is down about 1 basis point. Chip stocks trying to recover from the previous session's rout. A big part of that, a profit warning from ASML Holding. Those shares down nearly 4% in Europe. Checking in with NVIDIA, they're up nearly 1%, and that's after falling nearly 5% yesterday. And finally, shares of fashion retailer LVMH under pressure, down 4% in Paris after sales fell for the first time since the pandemic. That's Bloomberg Business Flash. Carol and Barry.
All right, Lisa, thank you so much. I don't know, Barry, if you have seen gold. Gold futures are up 25%. They're moving toward a fresh new high. I guess investors thinking about the U.S. election, that, we were just talking about how close that race is. The precious metal is one of the strongest performing commodities this year. Record after record after record. And, safe haven, I get it. Central bank buying, I get it, but there's a lot going on. Who knew?
Yeah, gold has kept one of the few things that have kept up with the S&P 500 for the better part of a decade, which is kind of shocking because for a lot of the 2010s, it kind of just puttered along.
Right.
You would have thought ZIRP and QE would have sent gold higher. It didn't. All of the narratives about gold failed, and yet here we are in 2024 on the verge of 2025. Gold at all-time highs. It's amazing.
Well, it's probably not too amazing to our next guest because Liz Young, she writes gold might be called one of the world's oldest assets when it comes to investing in gold. It might also be called the oldest trick in the book. An old-fashioned idea and even boring. But she says, as boring as it may seem, it has actually, as Barry mentioned, has outperformed the S&P 500 on a year-to-date, 1-year, and 3-year basis. So maybe being boring is not a bad thing. Liz Young Thomas joining us. She's Chief Investment Strategist over at SoFi joining us. Gold. Who'd have thunk we'd be thinking, Liz, or talking about gold here? But yeah, we've been talking about it a lot here in 2024.
We sure have, and it is pretty remarkable, the performance that we've seen from gold, especially, as you all mentioned, it hadn't really kept pace with stocks for such a long time. And really, if you look even over a very long-term history, the average annual return for gold is a few percentage points below the S&P. So generally, you don't expect gold to keep pace with risk assets. And traditionally, gold is seen as a defensive asset. Right now, I really don't think that's how most people are using it. But I think maybe the more interesting part is that most people aren't using it. This has been a lot of institutional buying. It's been central bank buying, particularly in China. And the retail investor has not jumped on this bandwagon yet, which I think is really is only a matter of time as people start to realize that gold has performed so well and are trying to figure out why that's been. The other thing that's really interesting about it is you can look at the commodity price, which has done really well, and then you can separate that from gold mining stocks, which do tend to be volatile. But the environment that we're in right now with energy prices decently low, and they've retraced quite a bit, even in just the last week or so, that's supportive of gold mining stocks as well. So we saw a good boost to gold miners yesterday, even in a negative environment.
So we know China historically has been a buyer of gold, as have people in India. It's for dowries and weddings. Obviously, that's a longstanding issue. And central banks around the world have been buyers. But to your question, what is it now that's the marginal shift that's driving gold higher? All of these other purchasers are purchasers, have been purchasers historically, will probably be purchasers in the future. Who's the marginal buyer that's helping to drive this rally?
I don't think there's a new marginal buyer. I think that the buyers who were already present started to buy more. So if you look at the history of when Russia invaded Ukraine and the idea of what we call the weaponization of the dollar, or Russia's inability to access its reserves that were in dollars, I think there were some central banks around the globe that thought they needed to make sure they had reserves in a different currency, so to speak, if the US dollar would perhaps not be available to them in a time of stress. So when you see what's happened in China, if you look at a chart of just the purchases from the People's Bank of China, it really skyrocketed after that occurred. A few months after that occurred, it started, and then it continued to rise. And if you overlay that with the purchases in ETFs, which is basically our proxy for what retail investors are doing, purchases in ETFs were falling over that period. So there hasn't been a new marginal buyer in the equity market for gold, but there's been an increase in the central bank buying and just institutional buying to use it as a reserve.
Hey, Liz, how much of, gold tends to do well, right, in an inflationary environment. It tends to do well in times of turmoil within geopolitics. So how much of the trade is tied to that?
Right now, I don't think there's too much of it tied to that, because if you try to look at times of stress, yes, gold has done well in times of stress. So the regional bank crisis, geopolitical stress, it has seen a pop during those brief periods, but it's also gone up during this cycle during really optimistic periods. So right now, I don't think it's necessarily about defense. But you're right to point out that in times of high inflation, it does tend to do well. Commodity prices in general tend to do well because they tend to track with inflation. The other thing about gold is that it's a zero yielding asset. So people aren't buying this to get interest income. They're not buying this for a yield. So if we're in a period where yields are falling, which lately yields have been rising again, but if we go back into a period where yields are falling and the Fed continues to cut rates and we have this steady period of treasury yields falling, you might see a renewed bid for gold in that environment. Because if the yields are not as attractive on other assets, then some of those zero yielding assets start to look more attractive.
So anytime, the difference between equities and commodities are you can own a broad index of equities forever. Commodities, you have to be more sensitive to the cycle. If it's a combination of post-pandemic inflation and geopolitical turmoil, what's the back end of this trade look like? If peace breaks out and inflation continues to fall,
that unwinding, perhaps?
At that point, do we want to get a little more cautious about gold?
Yeah, so I don't look at gold as something that you set and forget. This is not a long-term holding, a staple holding in the portfolio. It is something that you do want to be a little bit more tactical about, but not tactical in the sense of trade in and out of it in a month's time. So we still are in an environment. Obviously, there are buyers out there. There's appetite for gold. I still think there is upside in gold, and I think there's upside in gold miners. But the indicator for me will be if we start to see the retail buyer come into gold in a big way, that tends to be right around when we're at least approaching a top in the market. And that would be where I'd start to take some gains. And even if you've held gold in a number of different ways, there's a lot of different ways to hold it. There's an ETF GLD, there's PHYS, you can hold gold miner ETFs. There's a lot of different ways to get that exposure. If you've held it for a year, maybe 2 or 3 years, you've done really well. It's okay to trim some of those winnings, but I don't think this gold trade is over yet.
All right. Good to know. Liz Young-Thomas, she's head of investment strategy over at SoFi, joining us right here on Bloomberg Surveillance. All right, folks, it is just about 20 minutes away from the open, but let's get another update on world and national news. We're back to Michael Barr.
Thank you very much, Carol, Barry, Lisa. Former President Donald Trump sat down with Bloomberg editor-in-chief John Micklethwait. Trump declined to say whether he has spoken to Russian President Putin since leaving the White House.
If I'm friendly with people, if I have a relationship with people, that's a good thing, not a bad thing, in terms of a country. He's got 2,000 nuclear weapons, and so do we.
Vice President Harris in the battleground state of Michigan wants to legalize recreational marijuana on a national level. While on the Breakfast Club with Charlemagne the God, Harris was asked about her position on reparations to blacks.
It has to be studied. There's no question about that. And I've been very clear about that position.
Harris will be interviewed today on Fox. In North Carolina, authorities say about 92 people are still not accounted for after Hurricane Helene hit nearly 3 weeks ago. In Florida, the cleanup and recovery efforts continue in areas hit hard by Hurricane Milton. The storm brought heavy flooding, and some neighborhoods are still flooded out. Governor Ron DeSantis in Zephyr Hills said more water pumps are being brought in to help.
Florida Division of Emergency Management has deployed 7 floodwater pumps to the Silver Oaks community here in Zephyr Hills, with another 20 pumps on the way for additional support.
Power has been restored to more than 4 million people. Meanwhile, in the wake of the hurricanes, the Small Business Administration has run out of money for its disaster assistance loans. Congress would have to approve more funding, and as of now, will not convene until after the election. There will be new calls for the release from prison of the Menendez brothers, convicted in the 1990s of murdering their wealthy parents in their Beverly Hills home. Today, almost 24 family members of Lyle and Eric Menendez will gather outside of the Los Angeles Criminal Courts building, calling for their release. Experts say new evidence may prove they had been molested by their father. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Carol, Barry, Lisa.
You're so serious today. What's up with that?
I know. I want to talk about, the Tigers or something.
Well, what's going on? What do I need to know?
Well, we're resting now.
You are resting now. You got a while to rest, right?
Yeah,
it's going to be cold
it's all
at
about
City
New York
Field
teams
tonight.
Right now. It's all about New York teams, I feel like.
It's going to be uncomfortably cold at City Field tonight, so you don't have to worry about that.
Yeah, that's true. You know what? The ball's not going to fly as far at City Field as it used to.
Denser air,
yeah,
for sure.
So, yeah.
Was it what?
I was going to ask, how come you're not called
right now?
Carol the Goddess? I love that name of giving yourself Charlemagne the God. Who gives himself that sort of name? Right?
Hey, Barry's is Carol the Goddess. I'm in.
That's
I'm
right.
in.
I'm
in.
I think we need to change your badge.
My husband does call me the girl. I don't know what that is.
Not quite the same.
Or the blonde girl.
I can't tell you what my wife calls me, but that's all right.
That's a family show. Family show. Keep it clean there, Michael Barr. All right, everybody. We're about 17 minutes away. I'm looking at NASDAQ. S&P futures just a little bit higher, Barry, so it could be a little bit of a mellow open, but we'll watch those financials in a big way. See if the semiconductor sector still under pressure or not. This is Bloomberg Surveillance.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And this futures report brought to you by IBKR. Markets never sleep, and neither does Interactive Brokers. Discover opportunities with CME Group futures across equity indices, interest rates, FX, energy, and more. Access CME futures around the clock at Interactive Brokers. All right, futures still pretty much treading water after big bank earnings wrap up with Morgan Stanley. Their shares right now, they are up about 3.5%. We have NASDAQ futures up 34 points, Dow futures down 7, S&P futures up about 2. The 2-year yield at 3.93%. That's down 1 basis point. The yield on the 10-year 4.01%, and that's down about 2 basis points. To commodities, we have Brent crude $74 a barrel, WTI crude $70 a barrel. We have spot gold at $2,682 an ounce. More economic data out this morning. MBA says mortgage rates rose for a second week in a row, climbing 6.5% for a 30-year fixed mortgage. That's the highest since nearly early August. And U.S. import prices fell by 0.4% in September. The estimate was for it to fall 0.3%. Tomorrow, we move on to retail sales. Companies making news. Qualcomm, sources saying it'll probably wait until after the U.S. election before deciding on a takeover of Intel. Then you have General Motors. It'll commit $625 million toward what would be one of the biggest U.S. lithium mines. That deal is with project developer Lithium Americas Corp. And finally, Toyota Motor Corp's research unit and Hyundai Motors Boston Dynamics, well, they're joining forces to speed up development of humanoid robots with artificial intelligence. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash.
Is that like those humanoid robots where, like from Elon, that actually have people like assisting them a little bit? The story that we've been talking about?
A little bit of a cheat there, yeah.
A little bit of a cheat. I know people were blown away by them, but it's like, are they really a robot if they're getting...
Someone's operating it.
Yeah. Got to work on that one. All right, Lisa, thank you so much. Hey, listen, Carol Massar along with Barry Ritholtz in for Tom and Paul here on the Wednesday edition of Bloomberg Surveillance live in our Bloomberg Interactive Brokers studio. Barry, I'm looking at the S&P up about 22% year to date. The NASDAQ 100's up 20%. Russell up 11%. We keep talking about it's a laggard, but it's getting there.
It's a laggard, but all those gains came in the third quarter. So
exactly.
It was the best performing sector. International emerging S&P, NASDAQ 100, the Russell was the best performer of all of them.
Stocks up 23%. I know it's taken a beating over the last 24 hours or so, but NVIDIA's up 165%. Vistra's up 233%. GE's up 87%. I I mean, you look at some of the market performance.
I know. I mean, GE is the outlier there.
All right. Palantir up 147%. But I'm just saying that you've seen some outperformance so far in 2024.
Yeah,
among a lot of sectors.
One of my favorite data points when I do my quarterly conference call for clients is I show a chart of the S&P 500 and show how many of the constituents are above the index average. And in second quarter, it was very low. It was about 144%. That's when the entire market was being dragged by the Magnificent Seven. Now, in the third quarter, we have 329 stocks above the S&P 500 average.
Yeah.
You like to see that. That's broad. That's a lot of breadth. And that typically is what you see in a very healthy, sustainable market.
It's what you want to see, a broadening out here. I wish I could show Barry's laptop, but we'll get to that. We'll work on that. Hey, let's see, with just about 10 minutes to go until the open, what Ross Mayfield has to say about the market setup on this Wednesday. He's investment strategist at Baird, joining us right now. Ross, we've seen a couple of sectors, certainly the semi area taking a beating. How are you looking at the open this morning? What's top of mind for you?
Yeah, semis are obviously top of mind. Just to Barry's point, there's still, that AI trade, that big tech trade is still such a big concentration in the market. Even with all this broadening out, they still matter to an outsized degree. So things like looking at China's commentary, looking at the earnings and the guidance from some of the big players, it really matters. But the good news is it matters less today than maybe it would have 6 months ago. There's plenty of other stuff working right now. So while we'll keep an eye on them, certainly longer term secular growth stories, we want to be owners. But overall, I think the market's still in a pretty good spot, even with these pockets of weakness here and there.
So Ross, you mentioned in your note that sentiment is a potential near-term risk. But when we look at where sentiment is relative to some of its more extreme readings, we're kind of middle of the road here, aren't we? What are you seeing from investor sentiment?
Yeah, we're definitely not in the bull markets die on euphoria stage of sentiment, right? I think things are much more in check than certainly the dot-com bubble, which draws a lot of comparisons. But I would say even like 2021 during the SPAC crypto meme stock craze, the VIX is elevated for making all-time highs. So you're seeing some sentiment readers, the AAII survey, put call data looks pretty muted. But overall, it's just kind of in the stage where it's like you ultimately need people to be bullish to sustain a bull market. You have to have people feeling pretty good about things, especially we've talked about all this cash in money markets, rates are heading down. Are people feeling good enough to pull some of that cash into stocks? So I think we're in a pretty healthy spot with sentiment. Near term, 1-2 months, who knows? Maybe it's a near term risk, but longer term, even intermediate term, I think we're in a pretty good spot there.
So let's stay with that cash and money markets. We were getting over 5%, and that attracted a ton of cash. I think we were $6.5 or $7 trillion in money markets. How far do yields have to fall for people to say, all right, I'm just not getting paid to sit in cash, and does that money then rotate into equities, or does it go into fixed income?
Yeah, so on the first question, I think they have to fall quite a bit farther from here. I mean, sure, rates are on their way down, but if you think about the last 15 years, 3-4% is a miracle compared to what savers were getting in the mid 2010s. And so there's a stickiness, I think, where people are still pretty excited about something in the 3 to 4% range. And with the soft landing kind of in play, the Fed is going to move slower than I think the market expects here, and probably have a higher neutral rate or a place where they stop and take a look around. So I think savers are going to be pretty content with what they're getting from money markets, even if it's a bit lower than what they've seen in the last year. As for where it goes, some of it maybe you could earmark for equities, but I think primarily, it's cash, it's liquidity. Maybe some of it is for the yield, and so it moves into fixed income. But I actually don't think a ton of that will be earmarked for equities once rates move down significantly.
Right.
Maybe the bull market is strong enough, but I think most folks are looking for yield there.
Yeah, here, I'll throw out some numbers for you. A stampede into U.S. money market funds. The industry's total assets to a fresh record, $6.47 trillion. Some $11 billion flowed into money market funds in the week ending October 9th. This is coming from the Investment Company Institute. This was data we got out last week. So this year's inflows, Barry, more than $500 billion, as you got traders kind of figuring out what kind of rate reductions we get ahead, what it means for borrowing costs.
It's amazing. And I just pulled up my personal account to look at, just as an example, the Schwab Value Advantage money market, 5.28%.
Why would you pull it out?
I mean, I'm kind of surprised how well this has been holding up, especially if we see a couple more rate cuts over the next few meetings.
JP Morgan saying it takes about 3 months for outflows to begin when the Fed is further along in the easing cycle and the Treasury curve is normalized and becomes stable. So safe to say, Ross, just got about 30 seconds left here. We might have to wait some time to see some of that money come out of the money markets.
I think so. I can tell you our clients over the last year and a half have been more excited about a yield on cash than AI or any other exciting technology. So I think that money's sticky. I think people love getting something on their cash for the first time in a long time. I think it'll be hard pressed to pull it out and find a new home for it.
Yeah, I don't. The other thing is I'm wondering, some of the things that we've talked about on air, and I don't know if you have any thoughts on this, Barry. Like, people keep money in money markets, though, right? Like they keep it. It's like the security, and I don't know how much will come rushing out.
Some of this is just inertia. If when you put, hey, we've been getting money sitting in a checking account gets moved to a money market account, and hey, I'm getting 5%. People tend to not look at that every day the way they look at equities.
Yeah, we do that a lot here. All right, we're going to leave it there. Hey, Ross, thank you so much. Ross Mayfield, investment strategy analyst over at Baird, counting us down to the opening bell on this Wednesday. Just got about 4.5 minutes to go. NASDAQ futures, we're looking at them a little change, call it unchanged. Same story for the S&P 500. We've got those opening numbers, though, coming your way in just a moment.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
The Bloomberg Interactive Broker Studio. I'm Lisa Mateo alongside Carol Massar and Barry Ritholtz with your opening bell report. So how the market's going to react as big bank earnings wrap up. We have Morgan Stanley reporting a beat across the board. We also learned U.S. Bancorp's lending income topped estimates in the third quarter, and Synchrony Financial reporting earnings per share for the third quarter that beat estimates. We are off and running, so let's get right to it. We'll start with the S&P 500. Right now, little changed, up about a point at 5,816. We have the Dow little changed, down about 10 points at 42,730. We have the NASDAQ up about 12 points at 18,327. We'll get over to the two-year yield, 3.93%. That's down 1 basis point. The yield on the 10-year, 4.01%, and that's down about 2 basis points. We have Brent crude, $74 a barrel. WTI crude, $70 a barrel. Spot gold higher at $2,680 an ounce. Checking with currencies, the dollar stronger, Japanese yen weaker, Euro weaker, British pound weaker. Right now we have Bitcoin up about 10% at around 67,000. At the open, let's check in with the banks. We have Morgan Stanley up 4%. We have U.S. Bancorp right now up about 4%. And finally, Synchrony Financial up 4%. That is your Bloomberg opening bell report. Over to you.
All right, Lisa, thank you so much. Lisa, there on the markets, just about a minute or so into the new trading day. Having said that, one of the things that's top of mind for investors, no doubt about it, economy, inflation, what the Fed does, but what happens potentially with the election outcome? Although a lot of guests that we've had on keep saying, it doesn't matter who's in the White House, that we'll continue to see some gains, certainly in the equity markets. Having said that, we do care what the candidates have to say about policies. And among our most read stories on the Bloomberg, an exclusive conversation between Republican presidential candidate Donald Trump and Bloomberg News editor-in-chief John Micklethwait that happened yesterday at the Economic Club of Chicago. Here's Donald Trump talking about inflation.
I had 4 years no inflation. I had 4 years no inflation.
But that was when you had much.
I had 4 years. It's better than that. And Biden, who has no idea where the hell he is, okay? Biden went 2 years with no inflation because he inherited from me. And then they started spending money like drunken sailors. They spent so much money. It was so ridiculous, the money they were spending. They were spending on the Green New Scam. The Green New Scam, the Green New Deal. You know, it was conceived of by AOC +3. She never even studied the environment in college. She went to a nice college. She came out, she just said, the Green New Scam. She just named all these things.
But President Trump, the issue at the moment, the markets are looking at the fact you are making all these promises. Latest one was car loans. You're flooding the thing with giving giveaways.
But we're going to grow.
I was actually quite kind to you. I used 7 trillion. The upper estimate is 15 trillion. People like the Wall Street Journal, who's hardly a communist organization,
yeah, but you don't know.
They have criticized you on this as well. You are running up enormous debt.
What does the Wall Street Journal know? I'm meeting with them tomorrow. What does the Wall Street Journal know? They've been wrong about everything. So have you, by the way. You've been wrong about
You're trying to turn this. You're trying to turn this.
You've been wrong about
You're trying to turn this into debate. There are business people. There are business
you're wrong.
people.
You've been wrong all your life on this stuff. You've been wrong. Let me tell you about currency. You're going jumping a lot of different subjects.
Whilst you're sticking to the subject very closely.
Let's stick to reserve currency. That's where you started, right? The reserve currency is under threat because you have Iran, you have Russia, you have China. China's the one that you have to worry about because they want it.
Yeah.
They want to have the yuan be the thing of power. So here's what I'm doing. Again, I hate to go back to it. If somebody says, and I know countries want to get out because they don't respect our leadership, they look at this guy, they say, you got to be kidding, and she's worse than him. By the way, I never thought I'd say this. She is not as smart as Biden, if you can believe it. This is not what, we had 4 years of this lunacy, and we can't have it anymore. We're not going to have a country left. Okay, currency, very important.
Yes.
And if you want to go to third world status, lose your reserve currency. We have to have that. We cannot lose it. If you you'll go to third world status in this country because you take a look at the way things are running. If a country tells me, sir, we like you very much, but we're going to no longer adhere to being in the reserve currency. We're not going to salute the dollar anymore. I'll say, that's okay. And you're going to pay a 100% tariff on everything sell into the United States, and we love your product. I hope you sell a lot of it into the United States, but you're going to pay 100% tariff. He will then follow it up by saying, sir, it would be an honor to stay with the reserve currency. That will be like just playing. That's not even chess, that's checkers.
All right, that, of course, is Donald Trump, Republican presidential candidate, former President Donald Trump, there with Bloomberg News editor-in-chief John Micklethwait at the Economic Club of Chicago. That happened yesterday. The full conversation, more than an hour. You can check it out at Bloomberg.com or on our podcast feed. Having said that, Kailey Leinz was there going into it, listened to all of it, and has been doing a lot of post after it. She's one of the co-hosts of Bloomberg Balance of Power. Kailey, good to have you back with us. One of the things I wanted to get to is Bloomberg News actually did some fact checking about some of the things that Donald Trump had to say. And let's start with inflation, because we just heard him opine on it. So what do we know? Because there was a little bit of inflation when he was in office.
Well, there was. And with so many economic metrics surrounding Donald Trump's time in office, we have to consider the pandemic factor. Because, yes, you did have inflation that averaged below 2% during the course of his 4 years. But in part, that is skewed because it did drop down to 0.1% during the spring of 2020 at the very height of the pandemic. So when he says we had no inflation, effectively at one point, yes, that was true. But that was not true in aggregate over the course of his administration. Also, when he contends that we were growing our way out of tax cuts during the administration, that too was not true. And again, we do have to consider the pandemic factor within that. So those are just some of the data points that we can actually point to during the course of his presidency. We have to just kind of try to forecast forward what the impact of some of the policies he's talking about now will be, which is where you find the vast majority of economists saying that his tax cuts would be additive to the deficit and perhaps inflation along with that. And of course, that his tariff policy will be inflationary as well, even though he contends that it will not be.
You know, Kailey, it's funny. Every time the inflation conversation comes up, I'm reminded of an interview I did with Professor Jeremy Siegel of Wharton, who after the first CARES Act, which was, the biggest fiscal stimulus since the World War II, and then the second CARES Act and the Response Relief Act and other COVID relief, both passed under President Trump. And on a bipartisan basis, Siegel was the first person who said, during the Trump presidency, this is going to be massively inflationary. It just has to work its way through the system. It's amazing that nobody's tagged him. And I think the choice was either much higher unemployment or inflation. But it seems sort of disingenuous to say, hey, I had nothing to do with inflation. Clearly, both Trump and Biden passed massive fiscal stimulus, and that's what drove most of the inflation.
Yeah, and we do have the numbers that bear that out. The Committee for the Responsible Federal Budget is a great source on this, and they have pointed out that during the Trump-Pence administration, more than $8 trillion of new spending was approved in terms of 10-year borrowing. $4.8 trillion of that excludes the CARES Act and other COVID relief. So yes, a massive portion of that was COVID relief, which was stimulative to the economy, as we have seen in the aftermath. But that was still $4 trillion of other spending that was approved as well. And of course, with the tax cuts, that was about $2.5 trillion of that. So we do have the numbers that show this. But yes, you're absolutely right. As the inflationary effects weren't felt until President Biden took office, it has really been the Biden administration that has taken the brunt of the blame on this, not Donald Trump. And of course, we know that supply chains were a factor in this as well, that the supply side, the much more difficult force of inflation to address, had a huge role to play in that as well. But that isn't always what has been reflected in voter sentiment, although Kamala Harris has been able to gain ground on the economy relative to where Joe Biden was. Voters don't blame her quite as much, it seems.
I highly recommend everybody check out the story on the Bloomberg, because it goes through the Fed, it goes through crime, immigration, auto manufacturing and where those plants are, Chinese plants in particular. You can find it at Bloomberg.com. Having said that, Kailey, you guys have been watching this for, the whole run-up, the change when Biden stepped out, Kamala Harris stepped up. The two, though, Harris and Trump, are on these massive media tours. And how much of this makes a difference in an outcome of a race that's, 19 days away now?
Yeah, it's very close. In fact, the election already is underway as early voting has started in a number of states, Carol, including in Georgia yesterday, where they set a turnout record for the first day of early voting. More than 250,000 people showed up. So a lot of minds already have been made up. For those minds that have yet to change, that is really where you're seeing them now target their media appearances. Kamala Harris today is doing an interview on Fox News with Bret Baier, which of course is not the friendliest audience or friendliest potential host that she could face. She's probably going to face difficult questions around the economy and immigration, her weakest issues, but it also is a chance for her to reach out to some of those Republican voters who may be reluctant to vote for Donald Trump and want permission maybe to vote for her. She has been trying to create that permission structure with announcing the endorsements of a number of Republicans, including Congresswoman Liz Cheney. For Donald Trump, he also is doing more reach out to other demographics like women. He taped a town hall on Fox yesterday with an entirely women audience, female audience, to talk about women's issues, including reproductive rights. You're seeing both of them do more outreach to Black men in particular. That is a group that they are really vying over, going to be key ultimately in the outcome of this election. That's why Kamala Harris did Charlemagne the God yesterday, part of the media strategy as well. So we're really seeing them kind of hit all kinds of mediums, all kinds of outlets in terms of their liberal to conservative bias as they try to reach those undecided voters, with very few of those undecided voters still left up for grabs.
So I'm fascinated by the early voting uptick. We saw something similar in 2020, but it was really more pandemic driven. How does this usually play out? If you see a big uptick in early voting, does that help? I guess there really isn't an incumbent, but how does that usually work out?
What we saw in 2020 is that those who vote early or who vote by mail did tend to be more Democratic voters. As Donald Trump has cast a lot of doubt on the efficacy of early voting systems. At one point, just a few weeks ago, he referred to early voting as stupid in the same speech that he was encouraging people to go out and vote early. So some of his rhetoric may affect Republican behavior in that way. We certainly saw that borne out in 2020 in terms of the mirage effect that it can create. If you look back to Pennsylvania, a state with 19 electoral college votes and a state law that says ballots that were mailed in cannot start to be processed until the morning of Election Day, what that means is the in-person voting was the results that were coming in first, and those were skewed toward Donald Trump. He was up 13 points by midnight on Election night, only for Joe Biden ultimately to win the state when all of those votes were tallied, which of course took 4 days. So it not only speaks to the fact that the results could look very different initially than they could at the end, and when all votes are in, it also speaks to the fact that it could take a lot of time to figure out who actually won, given the way in which a lot of these alternative methods of voting need to be processed.
I remember it last time around, and we did a lot of waiting and a lot of extended broadcasts, just waiting kind of for the process. It was uncharted territory, safe to say, for so many of us in terms of covering a U.S. election. Great stuff, as always. Kailey, looking forward to it. Catch her on Balance of Power later on Bloomberg Radio and Bloomberg Television, coming your way a little bit later on. What? You're nodding your head. What are you thinking?
I'm nodding my head because everybody's talking about this taking days and days and days. I think
unless it's right.
I think if the blue states in the Midwest break one way or another, we may know, around 12, 1 o'clock in the morning. If that sweeps for Trump or sweeps for Harris, then the election is essentially over. She can't get to 270 without those, other than the other 4 swing states, and that's a much bigger lift.
Totally agree. And all I would say is that, we've been fooled before by polling.
Consistently terrible.
Exactly. So we say it's close. What if it isn't a close race when all is said and done? And that will ultimately determine whether or not we know by the end of evening, do the networks make an early call? Do we make an early call?
It'd be a relief.
It would be a
great relief, and the markets would rally regardless of outcome.
Totally agree, because it means the system kind of back to normal, right? And that's what they would love to see. All right, folks, we've got a mixed market on this Wednesday, a little bit higher in the Dow, but the S&P and the NASDAQ a little bit lower. All right, let's get a check on world. This is Bloomberg.
Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Stocks right now fluctuating after a sell-off driven by some of the world's largest chip makers. A big part of that, ASML. Shares right now down about 5% in Europe after disappointing third quarter earnings. Now, its CEO said he expects a slow chip market recovery to extend well into 2025. Shares of NVIDIA that took a hit fell 5% yesterday. This morning, NVIDIA right now up about 0.3%. Let's get to the NASDAQ right now. Down about 0.3%, 65 points, 18,248. We have the Dow down 0.2%, 107 points, 42,845. And the S&P down about 0.1%, 5 points at 5,809. The 2-year yield 3.92%. That's down 2 basis points. The yield on the 10-year 4.0%, and that's down about 2 basis points. Amazon, along with billionaire Ken Griffin, they're among the backers of a $500 million investment in small nuclear reactors. Now, Amazon has signed agreements to develop this new breed of reactors, investing in X Energy. And finally, Carol and Barry, not sure if you've been to Disney's Florida theme park lately, but there's a new cake shop. It's set to open. Parents are sounding off on social media about the prices. A slice of cake at the Cake Bake Shop by Gwendolyn Rogers will run you as high as $26.
That is insane.
For one slice of cake.
That is insane. Come on.
Not fair.
It's cake.
Insane.
It's cake.
It's only cake.
But there are all these new tea shops and cake shops in Manhattan where $20 for a slice of cake is not unreasonable.
All right, but that's New York, and we're insane too.
Well, Disney and New York are almost the same prices, right? You can't get out of Disney for less than $500 a day. That's what it feels like.
I will say, when I took my daughter to Disneyland like 10 years ago, or Disney World, I loved it.
Yes.
I was all in. She's like, Mom, don't you want to live in a castle? And I'm like, yeah, totally. I'm in. All right, that $27 cake, though. I don't know. It's like a drink in Manhattan, too, right?
Right. $18 for a mixed drink, $23 for a glass of wine. It's kind of
cheaper to buy a house.
Oh,
no, it's not.
People forget it. Inflation isn't just the rate of price increases. Once prices are up there, you can have zero inflation, and everything is still much more expensive than it was.
Kind of crazy.
Including wages.
All right. Lisa Mateo, thank you so much. As you know, it's Carol Massar along with Barry Ritholtz. We're in for Tom Keene and Paul Sweeney here on Bloomberg Surveillance. We do want to talk a little bit about what's going on, though, in the housing market, because we have certainly been watching the statistics. We talk about not enough supply, a lot of demand, mortgage rates high, mean people aren't going to move when they've got 2 or 3% mortgages. Let's see what Selma Hepp has to say. She's chief economist over at CoreLogic, joining Barry and me right here on Surveillance. Selma, housing market, so important to the U.S. economy. How are you looking at that sector right now?
So thanks again for having me, first of all. It continues to be all about mortgage rates, and we see movement in home buyer activity as soon as mortgage rates go up or down. And with early September drop in mortgage rates to the lowest level since February of 2023, that sparked a lot of optimism in the housing market. And we saw a lot of buyers coming back. Inventory was up as well, and a lot of refi activity. But since mortgage rates jumped, we saw considerable slowing of that momentum. The 30-year rates now are some 50 basis points higher than that early September low, and that it has had impact on consumer demand. Remember, consumers are very well aware of what's happening with mortgage rates, and they listen to people like us who talk about mortgage rates being lower down the road, and they're waiting. They're sitting on the sidelines and waiting for those lower mortgage rates.
So that's the big question. How much further do mortgage rates have to drop to free up all of that locked up inventory of people with the golden handcuffs of 3 or 4% mortgages?
Yeah, I think that is the biggest question in the housing market is when we unlock the housing inventory, we are already seeing considerable improvement. So on a year-over-year basis, inventory is up some 20 to 30%. Granted, it is more higher in markets with where we had a lot of new construction, or in markets where there's been other issues such as insurance costs and property taxes. But overall, yes, we are seeing, even in a market like California, that was the most locked in market for a long time due to a number of reasons, particularly very, very high home prices, we are seeing some unlocking of that housing market. Remember that 40% of homes are owned free and clear, so they're not tied to mortgages. And for those people, it doesn't necessarily mean what happens to mortgage rates in making their decision to put their home on the market.
So let's skip the mortgage and focus on the 40% of people that either are cash buyers or don't have a mortgage. You know, we've seen a number. We were just talking about Ken Griffin's condo in Chicago. We've seen the high end kind of go crazy, and now it looks like it's starting to, I don't know if the right word is moderate or pull back. What do you see in the, I don't know, let's call it 3 million and up market? That's usually cash buyers and not mortgage-based buyers.
Yeah, absolutely. Those buyers do tend to be more sensitive to what's happening in the equity markets, but maybe what's happening with the election, you know, how does that impact their tax burdens? And so it may be some effect of that going on at the moment. But overall, high-end market is still doing really, really well. I mean, in fact, when you look at what segment of the market is performing the best relative to other segments, it is the higher end of the market.
Well, so, you know, I was thinking about, and I've been looking at like home building stocks in particular, rallying this year. They're up more than 28% so far. You know, in terms of building out and adding to that supply, it's local, it's permits, it's zoning. It's not so easy. What do you see in terms of some of the housing fundamentals when it comes from a builder's perspective?
Yeah, it's, you know, for builders, there are a lot of constraints out there. You know, there's a long list, regulation, zoning, labor costs, materials. You know, we have supplies issues, again, being a concern. But then a last one being, or one of the most important one being cost of land. And when you look at which component has increased the most in terms of cost, it's actually been cost of land. And so wherever you have market where it's much more expensive to acquire a piece of land, it will be less likely that you're going to have a new construction. So new construction market is very bifurcated. You have a lot of new construction in Southeast, anywhere between Texas and Florida, where the cost of land is much less expensive versus East Coast, Northeast, or even the West Coast. And as a result of that, for example, now of more new construction in these areas in South and Southeast, the rate of home price appreciation has been slower. You know, it's a supply and demand. You have more supply, which is slowing the rate of home price appreciation in those markets. So the really interesting data point I saw not too long ago was states that had a higher construction rate tended to have higher GDP. And when you look at places like New York and California, NIMBY, not in my backyard, has really reduced the pace of new home construction and helped keep prices high. Is there any hope that that might change in the future? Well, California has made a lot of improvement in terms of allowing additional dwelling units, ADUs. Actually, the number of permitted dwelling units increased substantially over the last couple of years as the regulations sort of adjusted better to being able to build these ADUs much more easier and having less restrictions on them. So I think the infill development is the within one's property, within one's parcel, is a solution for some of these markets that have a really strong NIMBY efforts.
All right, going to leave it on that note. Hey, Selma, thank you so much. Selma Hepp, Chief Economist over at CoreLogic, talking a little bit about the housing market. Hey, listen, that's going to do it for us. Time flies. 3 hours.
Right?
Give us 3 more.
Right.
No, we don't want to do that.
Carol the Goddess, thank you so much. And the name of that cake place, Lady M. It's next to my office downtown.
Lady M, right?
A cake is $125, so $20 a slice, not that much.
Good cake.
Fantastic cake.
Okay, so it's worth it.
If you can take the calories, for sure.
I just want to say about that Ken Griffin penthouse that went for sale, and I guess he lost some money. 7,500 square feet, 38th floor. He never lived in it. It was marketed as unfinished.
He has a number of properties around the country.
I'm so sure.
I think he'll be okay.
All right, everybody. That's going to do it for Barry Ritholtz and me. Paul Sweeney and Alex Steele coming up next. Keeping an eye on the markets. Little changes here. We go out with a little Bruce Springsteen, New Jersey, my home state.
I could use just a little
Good day.
You can't start a fire. You can't start a fire without a spark. This gun's for hire. Even if we're just dancing in the dark.